Good morning and welcome to the first session of the second day of the International Research Forum on Monetary Policy Conference. As a former co-organizer of the International Research Forum over the years from 2010 to 2018, so I'm really delighted that this conference has consistently upheld the high quality standards over these years. And this commitment to excellence was clearly also then demonstrated yesterday by the high quality of the papers that were presented, but also by the insightful comments from the discussants and also the audience. And I'm confident that this commitment to excellence will also be upheld in this session here, but also then in the remainder of this conference. And with that said, I would like to give then immediately the floor to Juan Ramirez to present his paper.
So this is the click here. It works. Okay, very good. Thank you for the invitation to the organizers. I'm going to talk about fiscal transfers today. Okay, and I think a relevant question for the ECB. Are they inflationary? This is joint work with Jonas Arias and Minchul Shin, that they are both at the Philly Fed. Okay, very good. So there has been, we all know. So there has been a post-COVID U.S. inflation surge, but it's not true. It's not only true in the U.S. It has been also true around the world in many other places. Okay, and there was early discussions about the role of either the fiscal side, the fiscal policy attached to the policies that were implemented through COVID. We know all the checks that were sent home in the US and many other policies that were done in Europe too. And there were also some concern about the effects of the supply side imbalances, basically supply shocks that could have been affected the inflation. Okay, so the beginning of the discussion about what is the source, what is behind this unexpected increase on inflation that we observed. There were a lot of discussions very informal discussions about supply and demand, and there were a little bit more of formal at the end, and there's a few papers that cite there about the discussion, okay? So what we want to do here is a little bit different, and what we want to do is basically think about time-varying SVRs. As you will see in a moment, time-varying SVRs are important here because both the transmission mechanism of these inflation shocks through the economy, these shocks to inflation in the economy, not only inflation but other variables, it's clear they have changed through time. So we need something that is able to capture those kind of things. There's other approaches we can take, but we're going to take this time-varying SVR. And another important thing is that most of the SVRs or time-varying SVRs that have been studied in the past, they have been not totally, but most of them has been focused on only monetary policy. We have a lot of papers about monetary policy yesterday, about time varying, things that change in monetary policy. We want to focus on the fiscal side of the equation and to see what are the effects of these fiscal shocks on inflation and other variables. Okay. Okay. Importantly, something you may know, but actually I was not so aware of, is that the role of transfers over GDP during the crisis, not only COVID, but also other cases has in the past, is dramatic. So there's a lot of work, a lot of studies that try to think about the effects of government consumption, government investment in GDP, the effects of changes, unexpected changes of government investment and government consumption over GDP on variables, but there is little analysis of the effects of transfer over GDP on variables. Okay, and you can see in this graph that the share of transfer to GDP has been increasing through time. That's not unknown, people know, but also the volatility. Okay, these things, how these shocks or how these unexpected movements on transfer of GDP have been growing through time. It's something that was surprising for me. We're not the first ones to talk about this. There is some people have already mentioned the fact that transfers play a big role in the economy and a bigger role through time. So, but I think we are the first ones that put it in a time-varying VR and to see the effects on these particular events of inflation and these kind of things. Okay, very good. As I said, we're one of the first ones. Reis has a couple of papers on this in the past. Never in an SVR, but he has some empirics papers looking at these variables and also some theoretical studies about that. Just to have an idea, okay, of how important these things are, okay, we can see here, okay, how the change of total expenditure, of the government expenditures, and then how we divide it in transfers and government consumption and investment, okay, as a percent of GDP, how they change during the two most important crises that we have seen in the past, the Great Recession and the COVID. So you can see the increase in total expenditure during COVID was around, the change on the percent, it was 11%, okay? Half of that was due to transfers, okay? Very little, or in comparison, very little was linked to government consumption, government investment. Something similar happened less dramatic, but something similar happened in 2008. Okay, so a big chunk of the government policies were through transfers, not through government consumption. So that's why we're trying to play a role, or trying to analyze the effects of government transfers into all this. Okay, now I need to describe the model a little bit. I don't have too much time, so I need to go fast about this. What is a rotation invariant time variant SVR? Because I think it's important. Okay, so normally when you do time variant bars, what happens is that you have statistical identification. Okay, because you have things that move. When you have things that move, basically through volatility, there is all this theory that tells us that you have statistical identification. Okay, and then there is no role for economics anymore, because basically everything is pinned down by the non-Gaussian movements of the shocks, okay? But that's a problem. I mean, you can do it, but that's a problem. There is a lot of literature on that, how you label the shocks that come out, how the shocks change through time once you put more time series, or more the sample grows. There is many problems associated to that. I mean, it's beautiful in the sense that statistics give you identification already, but there's problems associated to that. So what we have done in another paper is basically to define a class of time variant SVRs that you can go back and use all the techniques, basically all the techniques that you were using on the constant parameter VERs in order to identify the shocks. Basically, you can bring economics back to identify the shocks. You don't need to rely on statistical identification, and all the problems associated with statistical identification disappear. Okay, these new problems appear because now you have to talk about sequences. You don't talk about matrices anymore. You have to talk about sequences of matrices, with the complications that you have both in the algorithms and also on the fact that the dimensionality of the space grows. So there is all these problems to do that, but at least we have the door open to go back to the things that we have learned through many years through SIMS about how to identify SVRs back into the time. And this is basically how you define the model. You have a time variant. The time variant SVR here, the shocks are identified because they are uncorrelated. Then you have a law of motion of these structural parameters, and the key is that you have not all the law of motions. The key to define this rotation invariant SVRs is that not all law of motions are allowed. Only law of motions that respect this observational equivalent concept of rotational. So you have rotations of the structural parameters, or sequence of rotations now, because you have sequences. The projects have to assign the same probability. We can, if someone is interested in these things, we can talk about it, but that's the class of models that we work on. Okay, very good. And the way that once you have this kind of models, the way that you draw from this kind of models is totally equivalent to the way you do it in the constant parameter VER. You define a reduced form with rotation matrices, the same thing, and you map it back to the structural wall. So the beauty of this class of models is that basically everything we have learned in the last 20, 25 years about constant parameter SVRs, we can apply to time variant SVRs with sequences now, but it's basically the same idea. There is nothing too deep about what you do. Okay, very good. So, but even in the case of this is true even for reduced form SVRs, for reduced form VERs, not only for structural models. It's like, how do you define this class of time variant VERs? It's not so simple. And what the problem is that you have to have a law of motion. You have to have something moving on the variance covariance matrix. And this variance covariance matrix is semi-definite positive. And drawing about things, I mean, semi-definite positive is a set of restrictions, very complicated nonlinear restrictions. And what happens is that you need to define a law of motion for that. That's not an easy exercise because you have to basically fall in the same subspace all the time. So having a law of motion that basically maps a subspace in the same subspace is not so easy. Okay, but there is very clever people around here. These people are Kanoff and Hansen. They have a very nice paper that shows that basically you can basically, there is a transformation. Everything in math is about that, transforming variables. Like you can reparameterize the variance covariance matrix into an unrestricted wall, but you can map this unrestricted wall to the set of semi-definite positive matrices and basically go back and forth, no problem. And that allows you to basically define law of motions about the semi-definite positive matrix through time. So that's something that we borrow from. They do it in the constant parameter case. We do it in the time varying case. But that's the thing, and that defines basically this class of models that we're going to work with. And the nice thing about this is that just something else is that most of the models that even in the reduced form world that consider time varying on the variance covariance matrix, the order matters. I mean, you have the famous paper of Primiceri that was maybe the first one that tried to think about these things, this difficult problem, and the order of the variables matters because they have Cholesky. You have a very large model, there is many orderings, okay? And then it's a problem because which one do you use? And then the results depend on the ordering, there is many problems. So this approach, again, is we borrow from Kanoff and Hansen, is order invariant. Okay, so you go basically what we try to do here is go back to everything that we learned in the constant parameter wall to apply to a time varying. Okay, and that opened the door to the same thing. There's a couple of things that you have to learn, but once you learn it, you go back to the same place. And this is the law of motion that we put in the variable, because once it's restricted, you can do whatever. This is basically something that this is the law of motion that we pick, but there is many other. You can put any law of motion that you want here. You want to put something that is stationary, you can put something stationary. You can do everything that you want here. Okay, there is nothing very bad. Then you have a Gibbs sampler with some restrictions that basically everything we learned in the past. There's a little thing we do elliptical sampler, but it's nothing. It's just an efficiency thing. You don't need to do elliptical sampler. You don't want to. You can do something that is less efficient, but elliptical sampler is very efficient. That we have another paper on that. And then there is one important thing that it's hard to do is to put zero restrictions here, because you have these things that you have to live in the semi-definite positive wall and you have to move. Putting zero restrictions is not that easy as in the constant parameter case. Okay, but there is in the paper we show there is a class of some zero restrictions that you can put. So you can consider some kind of zero restrictions, but it's not as flexible as in the world of the constant parameter case. But this is the part of technique to see the framework that we're using, but let's go to the economics of it, okay? So we're going to consider a 6-variable SVR with this in the class of models I just defined. We're going to consider transfers over GDP, okay? Real output, real GDP deflator, 1-year treasury yield to think about monetary policy, this supply index, but basically trying to measure what is the problems with supplies that we saw during the pandemic. So try to measure like you have problems on the supply side, and then personal saving rate. I mean, it's very interesting. Personal saving rate was behaving very different during the pandemic than during the Great Recession, and without that variable there, the results were very strange. Okay, one important thing that people sometimes forget when doing SVRs is that you have to have a very good reduced form model. You don't have a very good reduced form model, your shocks are going to be crappy, and if your shocks are crappy, or your innovations are crappy, your shocks are going to be crappy. And then sometimes we forget about that. And one way to test that is to think about the unconditional forecast or that you're going to get out of your model at any particular moment of time. So you go to any particular moment of time and you try to forecast with your model what the future is going to look. If you get inflation going to minus 10% for the next 5 years, it means that your reduced form model is very bad. Okay, and things like that. So you have to have a kind of coherent unconditional forecasting of your model at any moment in order to think that you have, at least is a necessary condition in order to have a reduced form that makes sense. Okay, and what we found is very interesting. So without the personal saving rate here, our model was forecasting horrible things. Okay, and if you want to do historical decomposition or some kind of analysis of the shocks, you need to have a model that is able to forecast the future in some sensible sense. Otherwise, it's very bad, and you will see what we're talking about. So it's very interesting because this variable changes through times dramatically. The importance functions of any shock to the personal saving rates is very different in 2008 and in 2020, and that was very interesting. So that's the sample that we used. And we use this sample. I mean, there is nothing. We could go farther. We could do 2026 if you want, because time varying is gonna be able to capture any shock that you see in the economy. I don't think it's a problem. But the exercise we want to do here is to stop in 2019 Q4, just before the pandemic, and do an unconditional forecast of the future without the agents or the models in the future and see what is the forecast and do the decomposition. So that's why we stop there. Okay. We could go further and do a smoothing, but that will be cheating because the model has in the future. So we want to avoid that from happening. Okay. That's what we do. Okay, so now we have to identify shocks. Okay, so when we identify a few shocks, the first shock we identify is this transfer shock. So we're going to have basically a policy rule of how transfers are determining the economy. Okay, you have the systematic part is equivalent to the fact that we have these Taylor rules. We have to think about the Taylor rule for the fiscal side. It's the same idea. So you have to think about the systematic part. And we're going to borrow a little bit from Blanchard and Perotti and Caldara Camps that have thought about these rules. If I remember well, they have consumption here. They don't have consumption investment. They don't have transfers, but we're going to have the same idea. Okay, we're going to borrow from them. So we have this rule here, and we're going to say just we're going to make our life a little bit hard here. Okay, because if we allow this rule to react to many other things, our life is going to be easier. So we're going to be a little bit tough on that. So what I'm going to say is that the transfers only react to output at the beginning. So basically, we're going to put zeros. All these coefficients here you see on the right-hand side, at impact, they're going to be zero. We're going to put zeros. As I say, there is ways to put zeros in this system. And again, this technicalities about that, you can read the paper or you can ask me. But we're going to assume that all the coefficients but the one on output are zero. Okay? And then we're going to say that the response of transfer to output is going to be negative. So basically, automatic stabilizers. Okay, you go in a recession, transfer go up. You go in expansion, transfer as a percentage of GDP go down. So typical thing. Okay, and we bound a little bit that coefficient. People do that. Actually, we borrow from Caldara and Camps too, because otherwise the things go so wide that it's very hard to learn anything. So how to bound is I think it's -4 or something like that. It's not a very tight band. Okay, because I think the median is around -1 or something like that. So it's not super tight, but once you allow for the tails of the posterior to grow, it's very hard. And you have sequences, it's very hard to see anything because the things this is very uncertain. So you have to bound that thing in some sense. Okay. And we want to see what is the source of inflation. We have to estimate. We have to identify the other shocks. We identify some demand, monetary policy, and supply, and other supply shocks. Okay, we have supply in the sense that we have tightness of the supply chain, and then we have other supply. Basically, will be the typical supply shock that we consider. Okay, very good. So these are the shocks. I don't have too much time, but there is nothing strange here. We don't hide anything here. It's like a typical sign identification to identify these shocks, because the idea here is that which shocks were driving the inflation that we saw. Okay. Just the need for time by MBR, we see in the estimation that things are moving in the right direction, so you need a time by SBR. So I mean, this is not surprising, but we put it there. So this is the important graph of the paper. So one do historical decomposition of which shocks were driving the inflation of 2020. Okay, that's the thing. So the 6 variables that we have. The dotted line is the unconditional forecast that I was mentioning before. Okay, the condition for the variables. And the black line is the data, what really happened. Okay, that's what I say. So the beginning, you need a model that is able to forecast and a condition forecast that makes sense. And the way that we test this, or we see if our model makes sense, we compare the forecast of our model in 2019 Q4 with the forecast that we saw in the market, basically. And the Fed, we look at the things, and the thing where they're not identical, but they are similar. So this is not crazy. The forecast that were coming out of reduced form, because that forecast is totally reduced form. It's not the total there. The forecast that comes from the reduced form makes sense. Okay, you have an inflation. I think it was around 2.5% that we get. Like for the future growth, it was around just a little bit below 2%, but something is real GDP growth, so it was something sensible there. Okay. And what happens then is that we want to decompose what happens with the unexpected. So basically, you want to explain the difference between the unconditional forecast and the observed thing. So you want to see what the difference is and which are the source of, so which shocks were explaining that thing. Okay, good. That's going to depend on several things. It's going to depend on the difference. It's going to depend on the response functions, and it's going to depend on the side of the shocks. That's the 3 things that matters here. So which shocks do you identify and how you identify them matters quite a bit. The first thing you see is let's think these questions about inflation. Okay, so what happens here is that the yellow is here is the fiscal shock. That's the thing. Okay, was the fiscal shock? These are cumulative. The thing was the fiscal shock behind the inflation that we saw in there. So what you can see here is that at the beginning, you will say that quite a big chunk of the inflation that we saw was due to these fiscal shocks. Okay, these fiscal transfer shocks. You can see it, but after very little, basically after a year, these fiscal shocks didn't play any role anymore. Basically, they were going the other direction. They were disappearing in the economy. It's mostly supply. Supply was what was behind most of the inflation that we saw during the crisis. So at the beginning, they were competing with the fiscal shocks, but after a little, the thing was mostly supply shocks. And the demand side was very subtracting for inflation. You had the demand side at the beginning of the crisis that basically people was very scared. They were not doing anything. So the demand was subtracting from inflation. Monetary policy was restrictive, actually, because actually you will see a little bit here, basically zero lower bound avoided the Fed from doing much more. Monetary policy was kind of restrictive, and was at the end, all the inflation that we saw at the end was due to the supply side. Okay. On the good side, these transfer shocks that created inflation in the beginning. On the good side, what happened is that they helped the GDP from collapsing. So they avoided the collapse of GDP. So they were very useful avoiding the huge crisis. So the Fed did, in this case, the government did a very good job at doing that. So trying to avoid the economy from collapsing. Okay, and you can see here what happens at the Fed. They were at the beginning. They reduced the interest rates very fast and very good. So there is no monetary policy shock here. They did what they had to do. So at the beginning, they dropped the interest rates very well. So there is no shock at the first period. But once they hit the zero lower bound, they were stuck there. So the economy demanded for more negative interest rates, but that didn't happen. So the interest rates, so the monetary policy shock was a little bit restrictive in that sense because there is nothing else that they could do about it. Okay? I have only 4 minutes and 45 seconds. So what happens if we use a constant parameter? So the main message here is that, okay, these fiscal shocks were very useful to stop the economy from collapsing, but they created a little bit of inflation at the beginning. There's a trade-off. Okay, there's a trade-off there. The inflation disappeared at the beginning, but also the effects on the economy on the real side disappeared too. So these shocks temporarily help stopping the economy from collapsing, but they created inflation at the beginning. At the long time, they disappeared because the shocks were very short-lived. But there is this trade-off that the government had to face. And maybe from this picture, what I will say is that's an opinion. They did the right thing. I would have done the same thing if I had known this will be the effect. Okay? But now what happens? You do a constant parameter BER. Okay? You do a constant parameter BER. So what do we lose if we do a constant parameter BER? Okay? The same idea, same colors. So I want you to focus on these two things here. So you do a constant parameter BER with the same variables. The forecast is very similar. So we try to do a constant parameter BER that has a conditional forecast almost identical to the time variance. So put it in the same place. What you will see here is that the trade-off that we mentioned before is not there anymore, in the sense that you can support the economy for much longer, okay, without paying a very similar cost of inflation. So you use a constant parameter BER to analyze this problem. What happens is that you can get a little bit confused. You can think that the power of these shocks is much bigger than what you really are, and you can use them a little bit more often than you should. So there is some gains of basically analyzing this thing in a time-variant BER because it tells you the trade-off is there, and it's more important than you will see in a constant parameter BER. These are the impulse response functions that you see out of the shock at the moment of 2019 Q4, because in a time-variant BER, the time-variant SBR, you cannot have this impulse response function changes through time. But these are the impulse response function that you have in 2019 Q4. Okay, good. Basically, you have these fiscal shocks can be inflationary. They have an important trade-off between output and prices. You have to pay a cost on inflation, at least in the short run, but you can support the output. That's what we find. Okay, time-variant BER is important to show this trade-off because you do a constant parameter BER, you don't see this trade-off that there. Okay, but importantly, the inflation during the pandemic was mostly driven by supply shocks. That's the main conclusion. Okay. Yeah. And transfers, and that's one thing I didn't put it here because I don't have much time. But these are the paper about Primiceri and Giannoni. They have this. Domenico and Giannoni have this paper about this, more or less asking for the same question. Okay, but one important thing they are missing in their analysis: don't put transfer shocks in the data set. So you look at the thing; they are missing the transfer shocks, and the results change quite dramatically about what are the effects, what is driving what. Because the question is a bit different. They are not thinking about transfer shocks. They are thinking about supply and demand in general. But you miss transfer shocks, you are missing a big part of demand, okay? And the results change a little. And we did exactly the same. So we put all the variables here, forget about transfers, and think about demand supply in general, and we got results similar to what they get, even the time-variant BER. So including the transfers into the BER makes a big change, and I think it's important. That's something we can do. Okay? I have 1 minute, but I want to say something. What about the Great Recession? We can do exactly the same exercise. We can stop in the Great Recession and analyze what happens there, because as you saw, transfers were important too. Not as important, but they were important. A few things that you learned. First, the shocks were not so big. That's the first thing. So the government didn't use these shocks, these transfers as extensively as they use in the pandemic. But we know that. I mean, we know that from the data at the beginning. We saw the big spike that we saw in the transfers, like in the raw data. And of course, you don't have this inflation driven by these shocks. But that's expected, okay? Because these were shocks. So one exercise we can do is, what do we put the shocks of the transfers? Where do we put the shocks of 2020 in 2008? So we'll have the same effect. We would have done the same thing with the economy in 2008 with the shocks of 2020, okay? And we do this here. So basically, we put the same shocks. We go there, put the same shocks, and it's true. We could support output, something similar to what we created in 2020. We can support output, so we don't have this large recession that we have in 2008. So we can support output. The behavior of inflation will have been very, very, very similar. You can see it, okay? And one big difference is that in that moment, because the Fed would have responded much stronger to, because the policy rule, the Taylor rule, was a little bit different. They were much more responding to inflation, and the Fed would have responded to inflation much bigger. And there were some effects. I don't have much time. We have -2 seconds, but you can see that the effects will be a little bit different in that sense. But the conclusion is that because the Fed was behaving different in 2008, the effects of the transfer shocks will be a little bit shorter-lived in the inflation side, because the Fed will respond a little bit. So.
Yeah, thank you, Juan Rubio. So the paper will be then discussed by Leonardo Melosi.
Thank you very much for inviting me to discuss this very interesting paper. It's a paper that made me think a lot, and I guess this is a definition of a very good paper, an excellent paper. I focus my discussion actually on a topic you haven't talked very much about, which I think is also quite good for the audience. You discussed very well about these rotation invariant time varying parameters, structure of AER, how they work, and the econometrics behind that. I think the three main innovation compared to the advantage of this approach is that you can introduce stochastic volatility, allowing you to have the great inflation period in your sample. Also, as you mentioned at the end, you can also take into account potential structural breaks. For example, you can take, if the model identifies that, you can get the steepening of the Phillips curve, which I think it plays an important role during the recent COVID pandemic recession. And then also you can capture time varying behaviors of the policymaker. Rubio hinted at that at the end, and I'm going to talk a lot about this, because that's exactly the part that made me think a lot about this paper. And the key results are that, and this is basically the feature I'm more interested in this paper, in this very nice paper, is that the effect of shocks depend critically on systematic monetary policy. And this is a really important finding that also, as I'm going to mention later, find in a paper with Bianchi and Faccini. In the data, this actually seems to be the case. So the Great Recession, there was a stronger monetary tightening, and therefore inflationary effect of shock were more contained. Whereas in COVID, the model detects slow and weaker endogenous response of monetary policy that amplified inflationary effects. So the punchline of the paper is that the supply shocks during COVID has played the leading role in explaining inflation. Fiscal transfer strongly supported output during COVID, but they create some inflationary pressure at the beginning of the pandemic period, and the reason was this lower and weaker response of the central banks. But what really made me think about this result, the systematic monetary policy response to inflation, is key to understand the effect of shocks, in particular fiscal shock. It made me think to the fiscal theory of the price level, which one of the key tenets of the theory is that the effect of fiscal shock, indeed all shocks, depend on how monetary and fiscal policy coordinate to stabilize public debt. And my paper with Francesco and Renato, we introduced these two notions of funded transfer shock and unfunded transfer shock that capture different way in which the policymakers coordinate in response to the effect of these shocks. So the question, however, in the data is an identification question. How can you identify the coordination between monetary and fiscal policy? And this paper suggests, no, that's at least my interpretation, that looking at how the central bank responds to inflation may be a way to say something about this coordination, the type of coordination in place. And this is the graph from Rubio's paper. I think is, for me, is the most important graph. So what they do here, they basically take the estimated fiscal shocks, and they feed the model with these shocks. The maroon is during COVID period, using the parameter estimated during COVID period. And the yellow bars are the effect of this fiscal shock estimated during COVID period, so the same series of shocks, by using the parameter estimated during the Great Recession. And you can see that GDP deflator, the response of inflation, is muted when you use the parameters estimated during the Great Recession. And if you look at the response of one-year Treasury yields, which is a proxy for the monetary policy, you can see that the maroon, the response during the COVID period, has been substantially weaker and more inertial, I would say, but definitely weaker if you consider the large increase in inflation caused by the transfer shocks. So this suggests that the inflationary effect of fiscal transfer depends on the systematic monetary policy response. I would say, that's my main comment to the paper, I would like to see a little bit more how other moving parts in your model contribute to that. Arguably, the slope of the Keynesian-Phillips curves becomes steeper in that period, so may also have contributed to this big contribution of fiscal shock to inflation. But the main result is that this systematic response of monetary policy may be important to assess the effect of shocks. And this finding echoes some of the finding I obtained in my paper with Bianchi and Faccini, where we find basically that unfunded transfer shocks are often identified during periods of weak monetary tightening. And we also use the term structure of the short-term interest rate in estimation, and it also helps the model identify this period. So monetary policy action and communication appear to be a key signal for assessing monetary and fiscal coordination. So if you look at the picture from my paper on the right, you can see that the black is the real interest rate, the red dashed line is the share of unfunded transfer. You can see that when the real interest rate increases, look, for example, in the beginning of the 80s during Volcker, the share of unfunded debt effectively falls, meaning that fiscal inflation becomes less relevant. So this, in my opinion, is a very interesting result that deserves more investigation. One interpretation of why monetary policy is so important to inform the econometrician, but probably also agents about monetary fiscal policy coordination, is that monetary policy is so simple to see. I can see how the central bank is responding to inflation. I can see how a central bank has responded to inflation in the past, that I can compare and infer something about how monetary fiscal policy coordinates. So the implication of this observation is that how we should build our VAR models. I agree completely with Rubio that we should have time-varying parameters. This is super important. But also, I think, and Rubio has in the estimation, to look at real hills to be able to capture how markets perceive the response of monetary policy when shocks happen. On the structural side, a model in which agents learn about the likely share of unfunded debt from the signal emitted by the central bank, and this communication seems to be an empirical successful model. I want to conclude to say that, however, as typically happens when economists find empirical regularity like this one, the importance of monetary policy to assess the monetary and fiscal policy mix, it may be the time in which this empirical regularity breaks. So in a situation in which central bank independence is under attack, and I would argue that in some countries that's definitely the case, this monetary signal for the monetary and fiscal policy coordination may no longer work. And actually, in the paper with Francesco Bianchi published in the GM in 2019, we show what are the very detrimental effect of this, what we call lack of coordination. So the fact that you may have a situation in which the fiscal authority loses credibility in stabilizing its debt, and at the same time the central bank is adamant to fight and to defend its independence. So here is a plot of an economy that goes through a recession, the dark gray area, and then the light gray area, the recession is over in a sense, so the aggregate demand shifts up again, but the fiscal authority has lost credibility. So there is no expectation of a fiscal adjustment. And the central banks, however, tries to defend its independence and raise the interest rate aggressively. You can see the real federal funds rate going up in the middle part of this of the bottom right graph. And when this happens, you get basically the federal funds rate increases. That creates a more fiscal imbalance. The debt to GDP ratio increases. The recession becomes deeper, and inflation will increase because agents expect that the rising debt will be stabilized with higher inflation in the future. And so the spiral of rampant inflation, increasing real interest rate, deeper economic contraction, and rising public debt is reminiscent of Sims stepping on a rake effect, and which can be summarized in a sentence by saying that the central bank is raising the interest rate to fight inflation, only to discover that its actions have fuel even more inflation. And in a recent paper I wrote, it's an old paper, but we have a new draft now with the estimation using euro area data with Bianchi Fang and Anna Rogantini Pico. I don't know, probably she's in the audience. We basically show that in a monetary union situation is such that it takes only one member country losing fiscal credibility for the central banks to step on a rake. And so this is something that we should take this into account these days. Thank you so much.
Yeah, I think what Malaysia have said is basically that we need to think more about the interaction between fiscal. They are doing those things, and I agree. The problem is that how do you do it explicitly? Do you make the Fed to respond to level of debt or deficit or things like that explicitly in the Taylor rule? So I think there's an interaction there, but making explicit. So is the fact that the coefficients of the monetary policy rule change enough for that mechanism, or you have to make it explicit? So it's not an easy question to answer, but I think you're totally right. And something you said about other structural parameters, that's true, and that's something we want to do, but I think this too many new things on this. So one of the problems of this time-varying BR is that because you have rotations, you have, in some sense, you have a huge steady space. Okay, there's some constraints because you have low motions, but there is a huge. So what happens is that the uncertainty is huge. It's very big. So what you mentioned about the New-Keynesian Phillips curve, that's interesting. So you can start thinking about which parameters are structural. So you can think about more about which parameters are structural and use restrictions on those parameters to bound the sequences. And with the elliptical sampler and the Gibbs sampler, you can do that very easily. You can put as many sign restrictions as you want, and then start thinking about structural parameters and basically bound things. So you have a more sensible. Because I'm sure some of the coefficients of the Phillips curve that we get make no sense. So some of the models are there; they make no sense because don't look at that. And there is some sequence, some realization of the sequence that doesn't make any sense. So I'm sure you can. So as I said at the beginning, one of the nice things about this model is that you can be an economist again. You have to have time-varying models and be an economist. But I think you have to be more an economist here than with the constant parameter models because you have many more parameters. So I think it's more I think there's more role for economics here than in the constant parameter model.
Okay, then let's open the floor. Oreste.
Thank you. Very, very nice presentation also and discussion. I was very intrigued by your results on the on the 2020 the inflation surge. So one clarification. So what you labeled there as bottleneck shocks, so this is, I guess, a supply shock.
It's a supply shock that basically strangles the supply chain.
Yeah. And so, so we can think of that just in comparison to the paper that you have mentioned by Giannone and Premicher, so they also have some form of supply shocks. And now on the demand side, that's the striking thing. So, okay, you emphasize the role of the importance of introducing transfers, but you also, with the time varying VAR, detect this less aggressive response of monetary policy to the shock.
They don't have it.
So in a sense, is this a right interpretation? That what you see as a systematic change, they see as monetary policy shocks, but maybe the distinction between supply and demand, broadly speaking, I mean, again, with this broader interpretation is
it could be that is the, I mean, the results are different, even with the constant parameter VAR. So one thing that we wanted to see is that, so what is the difference? Is it including transfers or moving from constant parameter VAR to time varying VAR? That was the question that we asked. And moving, if you keep transfers into the VAR, moving from the constant to the time varying, it changes a little bit the composition, but it doesn't change the story. So it's still different from the story of them. So it's including the transfers that makes the big difference between the explanation what is supply or demand shocks. Why? Maybe it's the interaction between monetary and fiscal. I'm not sure. I'm not sure what is the reason behind that, but it's including the transfer what is key. It's not constant versus, and it's true. The big difference is that we have a different composition of demand shocks. The supply side is very similar. The kind of shock in the supply side is very similar. Is the demand side. So maybe the interaction between monetary and fiscal. I'm not sure, but I really cannot pin it down.
Okay, since I still have the microphone, what about the past? There was this older literature about time variation only in the in the conditional variances, or also in the level parameters of the VAR. What do you?
So we find both.
Both.
Both. There is no discussion about that.
I suggest that we collect a few questions. And
sorry.
Give back the floor to you. Guido first.
Hi, excellent paper and presentation. So you probably know there's a paper by Lorenzo Mori, PhD students of Ephraim and at Padova and now at the Bank of Italy, that does exactly something similar with in a constant parameter VAR. So yeah,
I know Lorenzo.
Shocks, yeah, and I know you know. So you get similar results in a constant parameter VAR when you introduce fiscal deficit shocks. And actually, in terms of the composition, I mean, these are demand shocks, right? So that means that demand matters, and mainly what's coming about fiscal policy. Going back to, so it's just identify different demand shocks, and it's true that the residual demand shocks are negative, but monetary policy is actually different because at the beginning, at least, it was late to the party, right? Because there was the zero lower bound, and inflation started to surge. So at the beginning, monetary policy also in the US was expansionary. So that's a paper that I think, and we had a similar work with Lorenzo and other people at the bank looking at the euro area and identify fiscal shocks and identify also supply chain by using, for example, you can use the supply chain of your Fed to identify maybe better your supply chain shock. And we do find it also in Europe, actually, fiscal shocks were important, more gradual, because they build up through the the next gen EU results, but we're also explaining a large chunk of the inflation surge, and yeah.
So we have next Bartosz, and then we have Michal, and then Matteo.
Great paper about the historical decomposition for the COVID period. So you estimate the model on the pre-COVID sample.
Until 2019 Q4.
Right. So, but it's possible the equation coefficients or the variances change during the COVID period, right? And that would affect the variance decomposition. So I think it would be interesting to look at also, in addition to what you did, also do a full sample estimation and repeat.
And there are two things here that are important. Oh, sorry.
Michal and Matteo. Michal? Yeah.
Michał Brzoza, National Bank of Poland. Very quick one. Did you try to express these results in terms of the familiar multiplier? I mean,
no.
Would be nice. Thanks.
Matteo?
But we should.
It'd be nice to see, Matteo Iacoviello, Federal Reserve. It would be nice to see whether there is some interesting relationship between the coefficients you estimate time varying and how they depend exposed on the variables of the model, because one would think that, for instance, the extent to which, say, the level of supply disruptions is high should show up in the slope of the Phillips curve or in some other parameter. So that would be an interesting extension. And the other thing is, this is the model where ideally you won't estimate it through the entire period to see exactly whether the parameters change around the COVID. I know that you're not doing that, but it'd be nice again to see, like Bartosz suggested.
Okay, final question then.
Ben Sabaro, CFED board. So you mentioned how important it was to include transfer shocks to be able to identify the big component of demand. And then Leonardo talked about how important it is to see the federal funds rate for the monetary response. But through the lens of the classes of models that have interesting monetary fiscal interactions, we could learn also a lot more from seeing, including deficits, including primary surplus among the observables, because those are crucial determinants of how much monetary versus fiscal policy dominates. Thank you.
Just a quick reaction.
So about your question, I mean, there's two things to be said there. So we stopped 2019 Q4 because we don't want to contaminate the estimates. But you're right about that. The right exercise that we don't do is to allow these decompositions with time-varying parameters, because there is law of motions. So we should do that. But the problem is an integration problem. You think about the problem, you have all these parameters moving, and then you have a period, so you have to do integration because you have to integrate. It's a Monte Carlo exercise. We cannot do it. I mean, there is no computers, at least. Maybe you guys have a very good server, we can do it. But there is a technical problem to do that. But you are right. It's like we are basically assuming that the constant are stuck in 2019 Q4. The parameters are stuck, and we should not do that. But there is no way for us to solve it at this moment. We could project it. We could project these things and do some neural networks, something like that. We could be clever about doing these things, but we were not clever enough.
Describing yet another decomposition. But you could do full sample estimation and then historical decomposition.
Yeah, but that will be a problem because you will contaminate the current parameters with the future. That's a problem too. So
Forecasting, you're interpreting the past.
we can talk about that, but I think it's a problem.
One is necessarily better than the other.
It's true. It's true. No, that's true. Both are wrong. But I prefer my wrong than your. I prefer my wrong than your wrong. About the multiplier, is true. We don't do it. We should do that. About Matteo is right. I mean, what Matteo is saying that these coefficients are endogenous, not exogenous. So we have exogenous law of motion. That's true. It's endogenous motion. We're doing something similar. I will talk because we're doing something very interesting on that regard. It's a very interesting thing we're doing. And what the fuck? I don't know what I put here. I don't know. I cannot read my own thing. And what you're saying about the fiscal side, you are right. I mean, I think we have spent 25 years talking about monetary policy, and there is very, very little talk about fiscal because it's much harder. There's very little talk about fiscal side. I mean, these people have been doing it for the last 10 years, and people haven't paid enough attention to them, I think. But because it's much harder, that's why they don't do it. So I think you're right. And the interaction that we are seeing between these two things now is super important. So I think we should pay more attention to the fiscal side. What you're saying, I think I agree with you.
Okay, then let me join.
Okay.
Final applause. And we then move immediately to the second paper, which will be presented by Martin Bodenstein from the Federal Reserve Board.
All right. Well, first, thank you to the organizers for including our paper on the program. This is joint work with my colleagues Pablo Cupa-Borda, Niels Gornemann, and Ignacio Presnov, also from the Federal Reserve, and the usual disclaimer applies. So shifting gears, this is towards open economy, exchange rates, and also a little bit in terms of style, away from empirical, a little bit more towards theory. So now, what is this? What are we trying to do here? Okay, so this is a paper about exchange rate determination and how we actually think about this in various macro models and where do we stand and what we can actually, what we personally have to contribute to this conversation. So let me ease you in a little bit. So if you look at the macro literature, in most of the prevailing international macro models, there's a sense that they struggle really with explaining exchange rate dynamics. So there's a couple of puzzles out there that some of you may be familiar with from various days and stages in your career. So there's the so-called forward premium puzzle. This is a question about how well can interest rate differentials actually predict exchange rates. there's an excess volatility puzzle where exchange rates are highly volatile relative to other macro aggregates, in particular GDP and consumption. There's the so-called Bucko-Smith puzzle, which is about the correlation of the exchange rate with cross-country consumption that most models get wrong. And so generally, there's a sense that, then there's an issue about exchange rate forecastability. So this paper is mostly about the first three. The last one is not what we are sort of exploring today, but I think it also has implications for that here. So in a sense, there's a notion out there that exchange rates and the macro variables are disconnected also. What I've just said, you could take a glimpse from that. And so the way to address this, or one way of how this has been addressed in the literature, is to sort of think of, well, there are some notions of macro shocks being, say, to investment, consumption, and other kind of variables, other kind of shocks that we think about in macro settings that sort of explain more or less the macro variables and the international dimensions of that. And then there is sort of a financial or UIP shock that explains exchange rate, but doesn't really move anything else. And so most prominently, I think in recent years, this came out in this work by Itskoki and Muking in 2021. And the way they introduce and I want to think about is right now is, so at the bottom of the slide here, we have the UIP condition written as this a change in the exchange rate relative to the change in relative to the interest rate differential. And so normally, so most models, this would be just equalized, but well, when you go to the data, that's not going to be the case. And so one way of reconciling then a lot of puzzles out there is by sticking in a shock in there into this UIP condition. And Oleg and Dima, they gave a nice interpretation to all of this and a lot of justification for this. So now what we are doing is we want to reconnect somehow some of these conversations. We are sort of moving back to sort of trying to find a fundamental shock that generally sort of has a potential to potentially affect more macro variables, but still resolves all of these various issues. And the approach we are taking is combining two elements in the international macro literature. So there's on the one hand, that's going to feature importantly in here is what we're going to label a trade rebalancing shock. So it's a shock that changes sort of the demand for the domestically produced good relative to the foreign good. And this is a stylized way that I'm saying this. You can extend this to all sorts of things, including non-traded goods and other stories. But so the key thing is about shifting demand from imports, away from imports to domestic goods, or the other way around, of course. And so things that can speak for this, just to give you some ideas, is stuff like tariffs, transportation costs, also preferences, and so on and so forth. But the other element that's going to feature very importantly in here is a notion of costly financial intermediation, something that, limits sort of risk sharing beyond of what we typically have in these kind of macro models in terms of risk sharing. So we're moving a tiny little bit, not much, a tiny little bit more in a more financially constrained world than what we often have in the macro literature. And so what this does, it gives rise to a second wedge, a second element in this UIP condition. So we have on the one end, as you can see on the slide, and in green, this is again the original UIP shock, which is sort of an exogenous shock, and introduces an endogenous wedge in there. So this endogenous wedge, it's this chi and times this b tilde, and I'm going to explain in a moment what they are. But as you can take from the coloring, so the chi is sort of governed by the strength of the restrictiveness in international financial risk sharing, and the yellow part, the B, is going to be tied to the trade balance. So that's kind of keeping track sort of trade deficits, past trade deficits in a manifestation through the net foreign asset position. That's this B in our case here. And so what I'm going to do for most of the part today is going to just take a very, very simple model in which I illustrate the story that we have. And but in the paper, we have a quantitative estimated medium-scale DSG model and all these with the various bells and whistles, and things gonna go through. So hold on, that was the wrong direction. So what are the key findings within this setup? Well, not surprisingly, both the UIP shock, well, that was by construction in the previous literature, but also the rebalancing shock, I'm going to argue, they can sort of address these various puzzles. They speak they speak sort of in a meaningful way to these puzzles that we have out there. So the forward premium puzzle, the Bucker-Smith puzzle, the exchange rate volatility puzzle. But what was going to be the key thing in here is, well, how do we distinguish then if some of these standard puzzles are both addressed by these two kind of shocks? How do we distinguish actually between these sources of fluctuation? And that's going to be where the trade balance itself is going to be very important to distinguish that. So the main finding is going to be that the rebalancing shock in our world end up explaining in the most complicated model, the estimated DSG model, that rebalancing ends up accounting for 50% of the variation in the real exchange rate, whereas the UIP shocks, who's important, have gone down to 15%. Whereas in other formulations in the past, if you leave out these rebalancing shocks, you actually would find that UIP shocks explain about close to 100% of the volatility of the real exchange rate. So now, let's go on here. Related literature. There's many people who have contributed to this. Giancarlo just joined. Is of course one of the people who contributed to that literature very prominently, but other people in the room as well. Don't want to spend too much time now on the literature, but just making sure that there is a connection also beyond the Skokie-Mukin work, and others have contributed to this work importantly. So now, what's the framework to give you a sense? So this is think about a very simple world. There are two countries. Each country consumes both the domestically produced and the foreign good. And this foreign good and the domestically produced good is produced just using labor. Households have preferences over consumption. This final aggregate consumption goods C, and they work for it labor. So here we have one simplicity that that eventually in the paper we generalize. So here you see that preferences are linear in labor. So, but you can ease that, and things are going through. It's just the algebra for parts of the paper where we show theorems is much easier this way. Now the two key elements that are coming in is in the budget constraint. It's this second line on the second equation on the slide. And so the key element is there this phi 1 TB. So this is like a wedge. That's here we model this in a reduced form, but you can think about it in more complicated ways along the lines of Gabex and Maggiore, where there's sort of an international financial intermediation problem that's in there. But fundamentally, it's a wedge that sort of when you're a creditor, you receive a little bit of a lower interest rate, and if you're a debtor, you have to pay a little bit of a higher interest rate. That's fundamentally just the wedge that's coming in there. Okay, and the last equation is consumption aggregator. This is where our rebalancing shock is coming in. It's these omega weights that here we just take really these shocks to these omegas as literally the shocks to that. But again, as said, so you can think about more complicated versions of driving this, and there's parts in the paper where we end up doing that. All right, so one last element I want to say on these shocks. Well, so they can be mapped in a lot of things. There's a longer tradition starting with Mundell. And again, so you can even think about this, about non-traded goods included in there, which is sort of the same sense that you're just moving away from sort of one type of good that's coming from abroad to whatever is produced domestically. Now, just one key definition. So in this very simple model I have here, so when I say have this delta there, that's the terms of trade in the model. And these terms of trade are actually going to be proportional to the real exchange rate, the Q. So whenever you see me saying delta goes up or down, that you can also think about Q going up or down. And the notation that I'm following here, if Q goes up, so that's a depreciation of the exchange, and if Q goes down, that's an appreciation of the real exchange rate. Now, briefly on these financial intermediation costs. So here we took sort of a very dirty shortcut. This goes back to the works of Tarnowski, actually, so specified some sort of financial intermediation costs back in, I think it was in the 80s. But it's in the reduced form, it's going to look exactly what the reduced form of Gabex and Maggiore is going to look like. So in this regard, pardon our shortcut here. So why do I drag you through all of this? Well, because you actually can summarize this model very neatly in just 3 equations in terms of the dynamics and how you can play through the intuition that's going on. And so those three equations are, well, one candidate, the first one you've already seen a little bit. That's just a generalized UIP condition. So we have on the left-hand side changes in the terms of trade. And then on the right-hand side, there's differentials on how country-specific technology evolves. So those are those Z's. And then you have these two protagonists in here. So the endogenous UIP deviations. So it's the chi interacting with the NFA position, so the B, sorry. And you have the UIP shock itself in there. Then we have the trade balance, which depends on the shift in these relative in these relative tastes. So the psi trade, this is just these are the shifters for these omega weights, and how they also depend then on the trade on the terms of trade. And then the last one is just the evolution of the NFA position. Now let me just briefly show you of how what we derive from there. And so that's sort of the key theorem, and what we have is in the paper is that, well, if we look at if we condition on shocks, both to the UIP and the rebalancing shock, so if we condition on those shocks inducing a real exchange rate appreciation, so then you find here differentiation how these things impact the economy. So the UIP shock leads to a deterioration of the trade balance, versus the rebalancing shock causing an improvement of the trade balance. I'll show this in a second through the equations that we had. Now the second element that you have is this chi, this financial intermediation issue. So the higher you make this chi, so the more you move away from an incomplete markets economy and a tiny little bit away from that standard formulation, and restrict a little bit the ability to smooth shocks through the trade balance, that's going to amplify the impact that the rebalancing shock has on the real exchange rate, but it dampens the effects of the UIP shock on the real exchange rate. For both shocks, though, so the higher chi dampens the trade balance movement. And so the way you can easily see this is in this is here through the system of equations. So if you look at the UIP shock, so it shows up only in the top right of the UIP condition. So if that shock goes up, so then what that means, you expect in the future a deterioration of the terms of trade. So you must have seen an impact, an improvement of the terms of trade, or an appreciation, real appreciation of the exchange rate. So that means this delta has to go down. So that's equation one. So if you just naively go through the various equations, so delta has gone down. So you go to the second equation, the trade balance. Well, that means the trade balance must have gone down. And if the trade balance must have gone down, then the net foreign asset position must have deteriorated. That's from the third equation. So in that regard, I'm not, this shouldn't surprise you given of what I've said earlier. And now you get a dampening effect, though, if you go back and say, well, Martin, you forgot that some of these variables show up, of course, in many equations. So if you jump back to the first equation, the UIP relationship, then you have this chi interacted with this NFA position, so you get this dampening effect. Because now the B has gone down, the chi is some small positive number, so you have a little bit of a dampening effect that the UIP shock must have had to start with on the terms of trade. So that's illustrating the second part of the theorem we had. Now the rebalancing shock actually operates primarily not through the UIP, but it primarily works through the trade balance side. And then, so if you have sort of people shifting away from imports and towards domestically produced goods, then so if that shock goes up, so the trade balance goes up. Starting from the trade balance, you have the NFA position is improving. Now with the NFA position having improved, hop to the UIP equation, the first one. So what you're going to see, so it's the end, again, the interaction with the chi. So the chi and the B interact. So now this works towards a real exchange rate appreciation in a similar way when the right-hand side goes up as explained earlier. And so now, though, with the terms of trade having improved, you get a dampening effect in the trade balance condition, because now, of course, with delta having gone down, you get something that pulls the trade balance in the opposite direction than the original shock. But it's not going to be big enough, so that's why it's a secondary effect. Now, the other thing we show is, and I'm not going to spend too much time on it, is that we show analytically that at least for this very simplified model, and then for more complicated versions of the model, we show it numerically, is that both of these shocks, the UIP and the rebalancing, they're gonna check off these other three puzzles that I introduced earlier. So both of these shocks, they end up leading to a lot of movement in the exchange rate and very little movement in consumption or GDP. They both introduce this Backus-Smith type correlation, so where consumption in the country goes up, that actually sees its exchange rate appreciating, which is something that often you don't see in a lot of macro models. And then when you look at the pharma regression, so this is about the UIP puzzle itself, you're going to find that this correlation is actually negative in our model, where often in standard models it ends up being positive and equal to 1. So I'm going to jump over these and just going to come to a quantification a little bit. So far I've just given you some theory, so now it's a question, what can this little model actually do? How successful can this already be in terms of distinguishing between these two type of shocks? And to do so, we go to a bunch of data moments that are featured prominently in the literature, and sort of try to sort of estimate try to sort of pin down a very small set of parameters that we have, and see whether we can, to what extent can we match these moments. And the key thing we're going to do in here, so we fix everything else. The only things we're trying to move around here is now the sky, so which is the hero of our story here, and the standard deviations of the shocks to match a bunch of moments here. So it's the autocorrelation of the NFA. It's the relative volatility of the real exchange rate to GDP. We're going to look at the persistence of the real exchange rate. We're going to look at the volatility of the trade balance relative to the real exchange rate and the correlation between those two. And so I'm not going to. So fundamentally, what I'm going to convincing you here first in this table quickly is, well, we're going to able to match this now, but why and how do we match this? And so this is probably more helpful to go to this graph here. So what we're plotting here, we're plotting here the data moments is these thinner red lines, and I want you to focus on those blue lines, which is sort of the full model, and it sort of shows you how does the model, how do the moments in the model change as you move around this chi, so this strength of international financial intermediation channel that we have. And so what you can generally tell is if you don't have this chi in there, then these blue lines are quite far off, these thin red lines. So it's so you're missing on a lot of important elements. Now you bring up this chi a little bit, so eventually you sort of hit very well most of the moments, except for the two in the bottom left part. But I don't want to spend too much time on it right now. But it doesn't certainly do worse than a model, which is the alternative model I'm plotting in here. So one with these red dashed lines, in which I've stripped out completely the story of the rebalancing shock by just removing it from the model, where the model does do miserably on a lot of dimensions. So the key thing is, in particular, when you look at the bottom right, so if you look at the trade balance and real exchange rate moments, so you definitely need another element in this model in order to fix that. Now, is this trade rebalancing shock the only one that can do this? Probably not, because you have always this is a very simple model with just 3 types of shocks. So the more shocks you have, the more you do. The more you're able, of course, of addressing certain puzzles. But the interesting thing is that in this context, not only do you, with this trade rebalancing shocks, and the slightly higher chi, not only do you match these trade balance real exchange rate moments, but you also simultaneously do very well on a lot of these other moments that we talked about earlier, in particular the real exchange rate volatility. And so, to give you a sense of how important this moving around of the chi is and how this affects the variance decomposition of the real exchange rate. So that's this chart here. So on the left, we plot the variance that's attributed to the rebalancing shock as a function of the chi, and the right one is the exchange rate variance that's attributed to the UIP shock as you move around the chi. And so when you shut down this channel, so this limited so these limits to international financial intermediation and put the chi down to 0, then the channel for our model just collapses, it disappears. There's nothing to be said for trade rebalancing shocks as a driver of the exchange rate, and everything goes to the UIP shock. Okay. When you, however, sort of allow for a little bit of this friction, you see very quickly picking out the UIP shock declining in its importance, and the trade rebalancing shock gaining a lot of more into prominence. It's very consistent with what I started out arguing in Theorem 1 of how the interaction of the chi with the importance of the shocks plays out. So then there's a lot of sensitivity and robustness and extensions in the paper to sort of make sure that this is not just specific to the formulation that we had. As I mentioned, most of those things under the first item already. Let me sort of jump to 2 points that sort of have been sort of important. So one is, so the alternative explanation to the Skokie-Mooking work, but also to our work, is the work by Keckler and Donnell, so who went to discount factor shocks as a source of explaining the volatility in the re-exchange rate. Now, so we can have long conversations about this. I think the key point I want to convince you of here is that the way that discount factor shock, so this is shock to the beta basically in the utility function of the household, so with how much they discount the future, it's isomorph in this formulation, in these 3 equations at least, it's isomorph with the UIP shock. There's some other dimensions where it's not isomorph with the UIP shock, and that's actually pertains then to the forward premium puzzle, where the Keckler-Donnell shock actually is gonna say that it's actually pushed more towards against the evidence in the forward premium puzzle, and would suddenly suggest much more as interest rate differential as part of explaining exchange rate. So there they push it more towards 1 actually in that world. But so in this 3 equations, it's isomorph. So in particular, because it's isomorph, it's not going to say anything new about the trade balance relative to the UIP shock. So it's going to have the same pathologies as the UIP shock in this world. Now, the other shock, the other dimension I briefly wanted to point is the labor supply, because I had it linearly. So now we introduce a different labor supply, so where we allow the labor supply to be somewhat less elastic, less than fully elastic. So you may wonder, well, in that case, you have a richer interaction. So the relative consumption differential is no longer just proportional to the terms of trade, as it is in the case when when labor is fully elastic. So you get a feedback mechanism from the trade balance into this relative consumption part. But that's not going to overturn the Backus-Smith finding or other elements to this regard. So this is just the picture to just we've done it. It works out. So it's not. It shouldn't be a biggest concern. Now, very, very briefly before I'm ending. So let me end on giving you a quick sense of the DSG model. So DSG model is, again, so it's the core block is what I just described, and then we enrich it with the usual bells and whistles. We estimate it using time series data, time series data, and so we do an exercise in which we try to figure out, well, if we fix the chi and then estimate the model for every chi new again, where would the log data density peak? And as you can see, so it's going to peak here on the left side, where I have the full model. It's going to peak sort of on the interior, where the chi is actually positive. And if I throw out the whole trade complex, then the chi that the model wants is actually very much to the left. And here I should stop and hand it over to Gernot.
Thank you. So the paper will be discussed by Gernot Müller from the University of Tübingen.
Okay, thanks a lot for giving me the opportunity to discuss the paper. I read it. It was a great pleasure. It's very well written. And I think it makes an important contribution to the recent literature on the disconnect. So here's some context. I mean, there is the very influential work by Skokie-Mooking. And the point here being that you have all these puzzles in international macro and finance. You have excess volatility of the exchange rate. You have Fama, you have Backus-Smith, you have Misi-Rogoff. And all these puzzles, they show can be explained within a fairly standard international business cycle model once you assume that international financial markets are segmented and you add this single shock to the UIP condition. So that's the story. So I think this paper was quite influential in the last couple of years and has, shaken the field, I would say. And it has also triggered, of course, some follow-up work. And I think the next paper in the list here is this Kekre paper, which Martin also mentioned. So their point is that these UIP shocks are all fine, except that they induce the wrong co-movement between the level of the real exchange rate and interest rate differentials. And so their take is you need more shocks, you need other shocks, namely persistent shocks to preferences to get the full picture right. So this is where Martin's paper comes in, the BCGP. And so they make a similar point. So they say, well, UIP shocks are good and fine, except that they induce a positive co-movement between the real exchange rate and the trade balance. So positive co-movement means here these UIP shocks appreciate the real exchange rate. It goes down. They also lower the trade balance, and you get a positive co-movement. While in the data, the two guys are unrelated contemporaneously. You see the correlation here is 0. And for me, Martin said, the Kai is the hero of the story. For me, this is the hero of the story. Yeah? So this 0 co-movement between the thing. Because you think, okay, the co-movement between trade and exchange rate, that should be part of the story. We cannot leave that out. Yeah? And so this is where the rebalancing shocks come in, because these shocks, they induce the opposite co-movement, offsetting what the UIP shocks get wrong, because they induce this a negative co-movement. And as Martin explained, this is no small feat, because that only works to the extent that you keep these international financial markets segmented, so that you need the Chi, otherwise you would screw up the other moment. So it's not that simple, but the paper is very well written and the mechanism is well explained, and I think the authors have a strong case. So against this background, I want to take to this look at this hero again. So the correlation between the trade balance and the real exchange rate. So that's for the US here, so in blue the trade balance and the real exchange rate as defined in Martin's paper, so it goes down, you have an appreciation. And indeed, if you stare at this picture, you'll see that contemporaneous correlation is maybe 0. You can assess this more systematically, also not only contemporaneously, but as I do here for lags and leads. So here we're looking at the correlation of the trade balance, from minus 8 quarters back in time to 8 quarters forward in time. And then you see indeed, so that's the paper, the BCGP, so there's 0 contemporaneous correlation. But then if you look a little bit more into the future, you see this positive association coming up. So that means that if you have a weaker exchange rate today, that is associated down the road with a trade surplus. That's how these variables are defined. It's a bit mind-boggling, of course, but we are used to that. Yeah? So, but some of you may be reminded of the, classic Bacchus-Kitland paper. This is where I started with Giancarlo working on international macro, like some 25 years ago. So they try to establish this, what they call the S-curve as a stylized fact, and they look at the terms of trade, which in this model is the same as the real exchange rate. And indeed, they show that for all countries they consider, you have this S-curve pattern. So contemporaneous correlation is negative or 0 for the US, mildly positive, just like in the figure I showed you. And then you go forward in time and that correlation turns positive. Now, I should say BKK, they do this in the context of a J-curve and are interested in this association, exchange rate and trade balances. But of course, they want to use this to push the RBC model, and they account for the S-curve pattern in their model only through TFP shocks. TFP shocks in their model depreciate the terms of trade, but they also induce an investment boom, which triggers a trade deficit, which is only later reverted, and that gives you the S-curve pattern in the data. Yeah? So I think that's good news for Martin here, because in their model, my hunch is that the rebalancing shock can also speak to the S-curve. Contemporaneously, you get this negative correlation, but then by staring at his impulse response function, I figured over time you get towards a positive co-movement. So bottom line is, with the rebalancing shock, you should also be able to account for the S-curve, and therefore consider a richer set of moments, which with UIP shocks, in the model, it seems that they also predict the wrong kind of co-movement here over time. So bottom line being a stronger case for rebalancing shocks still. Yeah, so that's good news, but there's a downside to it, I would say, if you pursue this. And the downside is, what I would say, you stay within what I would call the game of moments, or say more specifically, the game of unconditional moments. What's that game? So the way I think about it is I watched the 8 seasons in order to prepare this presentation here. But so you have this iron throne of moments where you have some unconditional, that's the key point, some unconditional business cycle statistics. In our case, the star, the hero of the show being like the zero correlation between the trade balance and the real exchange rate. Yeah? And then you have the shocks making the claim for the throne. So here you have Itsukoki-Mukin, the UIP shock. Here's Kerker and Enel, and here's Martin, rebalancing shock. And they claim this throne. I mean, this is a fun game to play, intellectual, very exciting. But the bottom line is, to the extent that we treat these shocks as unobservable, this game never ends. Yeah? So there's always new shocks coming up and entering the show, which we may enjoy. Yeah? But we can also try to be a little bit more ambitious and move beyond these unconditional moments. Yeah? And I think there's a precedent for that. The precedent, Ghali's 99 AER piece, where he argues that he puts forward direct evidence for the transmission of specific shocks. You may remember, like in the decade prior to that paper, the literature has been put forward additional shocks or added shocks to the RBC model in order to make it match the unconditional correlation between output and hours. One example being Cristiano Eichenbaum adding government spending shocks. But then Ghali finds, by looking directly at these TFP shocks, that they lower hours, and so that speaks directly against the fundamental transmission mechanism in the RBC model. So for me, the upshot is, of course, you can bring 2 shocks together to get the unconditional moment right, while both shocks give you the wrong transmission mechanism. So can we learn something for the disconnect debate? I think, yes, we should try and move forward and establish direct evidence for specific shock transmission, rather than looking at the second unconditional moments. Of course, we are not naive. There's no free lunch. Then the cost is identification troubles. But I think Martin, in their paper, they explain nicely that this rebalancing shock can be thought of as either tariff shock, transportation cost shock, or preference shocks. So these we can partly observe, I would think. Yeah? So what I do here then, in the remainder of this discussion, I pull a measure of UIP shocks from a recent paper by Alan, or rather I got it from Jorgo. I give him credit even though he's missing right now, but okay. So I take his UIP shock, which is reconstructed the Allen series, and I take, as a measure for the rebalancing shock, I take the transitory tariff shocks identified in a recent paper by Schmidt-Grohe and Uribe. And then I run some local projections where I look at these variables which are interesting me here. So that's the real exchange rate and the trade balance, how they respond to these shocks. Okay, and this is what I get. So the top panels, let's focus on the top panels for a second. So this is the response to the UIP shock. Yeah? Trade balance left, real exchange rate right. The real exchange rate appreciates as the model says it should do. Yeah? So here you get this positive co-movement. Trade balance deteriorates, real exchange rate appreciates in response to UIP shock. So that's all fine, confirming directly the transmission mechanism built into the model. Yeah? Bottom panels give you the response to a tariff shock. Yeah? And here you see, again, consistent with what the model predicts, that the trade balance goes up in response to that rebalancing shock. But the real exchange rate is not appreciating as the model predicts it should. Yeah? So in this sense, in response to the tariff shocks, we don't get the kind of negative co-movement which in Martin's account we should have in the model in order to offset the positive co-movement which we get from the UIP shock to get overall to the zero correlation. Yeah? So bottom line, I think we should look at, try to come up with direct evidence. And for the UIP shock, it kind of works here according to my estimates. For the tariff shocks, it doesn't seem to add up. Yeah? But I think there's a way forward because, you know, you may try other rebalancing shocks, yeah, for instance, transport shocks. But I think what's important is we should be a little bit more ambitious, establish direct evidence rather than, you know, playing this game of unconditional moments with unobserved shocks doing all the heavy lifting. Yeah? Summing up, I think it's an important paper because it brings the correlation of the trade balance and the real exchange rate back into focus. And this is where it belongs if we talk about exchange rate. We are concerned about trade, apparently, these days. So my hunch is we are not done with the exchange rate disconnect yet. Thanks.
Thank you. Martin, would you like to quickly respond?
Yes. So first was very much appreciate the comments, Garrett. Thank you so much also for watching TV in order to come up with the game, the throne of moments. No, so points very well taken. I think so we thought a little bit when we went to the DSG model estimation that was a little bit our shortcut or dirty way of thinking more about establishing more direct evidence, but fundamentally it still lacks the kind of finesse that you did in the local projections, and probably going to be in touch more about what exactly you did there and how to sort of read and understand some of that, because there was a little bit of a promising part. So, I mean, it wasn't significant in your LP project, in your local projections, but on impact there was a very tiny appreciation of the exchange. So we'll look into that a little bit more, but also look at other measures. And I've also recently come across other measures of sort of any kind of trade friction. So I think this is a very worthwhile path to continue, because you're totally right. So you can always try to play this game, but I think it was somewhere in the context of some of the conversations yesterday as well. I think you can amp up the game constantly, and eventually you don't really know sort of. You have many things going on, and then you lose a little bit sight. So establishing direct evidence is very much appreciated. So on the I also like the comment though about the trade balance and the interaction and the sort of the lead lags with the exchange rate. So that's something we can easily do. I think that probably the estimated DSG model takes some of that already on board because it uses all the data. But yeah, that's something to check a little bit out more. But I think you're right, so that the model actually should be able to speak to that already, even in its simplest form. But yeah, thank you again for taking the time and very insightful comments.
Thank you. Then let me open the floor.
Well, thank you for this very nice presentation and discussion. And I have a basic question. So, as we know, as part of the effects of these trade rebalancing shocks may heavily depend on our assumptions about elasticity of import and exports. And we know that these elasticities may also depend on may change over time, or they may depend on other choices that we make into the model. So, you know, whether a model at the end is able to capture the correlations heavily depends on the specific assumptions we make about those elements, and how should we think about it?
Kite?
I think this Kite Küster, University of Bonn, that's probably a weird comment to some extent. Certainly it is. Now, the question is, I mean, you have these international puzzles, and you have precedent in literature for what you're doing. On the other hand, you know, people who haven't read the previous literature may think of the exercise as you going on a fishing expedition, just throwing in certain elements and see what works. So why not throw in other elements and see what works, and try to, you know, build then, you know, more micro-founded theory for why these elements do work in UIP deviations? No, it's a question on the, like, you know, intellectually what we get from the exercise.
So I would have an additional question regarding the role of the financial intermediation element. So this is, of course, also then implicitly providing very strong restrictions, so that, say, the net foreign asset position is stationary. And the model then, of course, requires exchange rate adjustment to return to the net foreign asset position. Now, in reality, we see huge and long-lasting deviations from a stationary net foreign asset position. So, and I was wondering, whether one, in the end, wouldn't need to rely also on an element of saving investment imbalances that are then ultimately driving then, say, also then the net foreign asset position. So it's basically the importance of the domestic imbalance that is also then having an important impact. So that's at least one thread of the discussions which are now held at the G7 level.
All right, so we're gonna, in the interest of wrapping up also the session. So, well, first, thank you for the comments. So, on David's point, so we did look at some time variation in the elasticities. We played around also with the elasticities themselves. So I think fundamentally we ended up, well, there are two pieces that inform us. So on the one hand, just generally the macro literature, and so we took guidance when in the first part when we calibrated the model of what sort of standard views there in the macro at the business cycle frequency. So it was sort of like something between, I think it was 1.5 or something like this. We took as an elasticity between domestic and foreign goods, in the estimation, so we opened that up and let the data speak more to what is that number, but also introduce some time variation through some import adjustment costs so that you had some of that. But yes, I think fundamentally there is an issue about the international transmission and what is the role of the elasticity in that, which goes a little bit, I think, also towards Kite's point. So the question, so you have puzzles and you throw a lot of things in there and you try, how do you address that? So I think the way we try to address this, I think when we go to the DSG model, where we open up more dimensions, more things that can compete with the explanation. And I think the key explanation comes out over and over again, regardless of how we contort and then kick the tires on it, the model just really wants to have these trade rebalancing shocks, and it wants to have this Kaiser being somewhat tucked away from zero. I think that is that's one attempt of trying to do that. This is not to say that building up from the bottom and with more micro-based theories one can do more, but that's just, I think, another approach of doing about that. So to Günther, so we haven't really, it's about global imbalances. I mean, that's one of the topics of the day. So the model does have some implications for that. I think we're not focusing on that, but you do get, of course, lasting departures here. The NFA positions are quite persistent, so you do get sort of some of these situations where one country is for a long time sort of indebted versus the other one. We can open this also up for having some more persistent changes in the original trade balance. So we haven't pursued that for this specific question for the exchange, because fundamentally we're looking here at a not like super high frequency, but still like quarterly stuff. But I think for some more persistent, longer ones, I think the model has something to say, but we haven't really explored that yet. But I think it should be reasonably easy, given that we have the estimated DSGE model and where we have capital and investment in it, and so we could at least talk about some of these dynamics. These are not all the elements that are relevant for the discussions on global imbalances, but at least somewhat in that direction. So we should be able to speak more to that. Thank you.
Thank you. Then let us provide a final applause before closing the session. So we will have now a coffee break until 11, and we will resume then thereafter. Thank you.
Okay, welcome back. It's my great pleasure to introduce our keynote speaker, Giancarlo Corsetti. I think everyone in this room knows Giancarlo, but just for the record, Giancarlo is currently also the Pierre Werner Chair and is a professor of economics at EUI, and before that, a whole string of other universities, including Cambridge, Yale, Rome, Bologna. And he's a renowned scholar on international macro, which these days, again, is very much back and alive and kicking, but also the link to monetary policy, which is what we always care about, and this is why many of us have followed this research over the years. And I would also like to emphasize that Giancarlo is one of those exceptions in the profession, also tries to think about applications to the euro area, treating the euro area as an open economy and not a closed economy, right? So now today he's going to talk about everything we care about today. And so the title has every buzzword in it: trade wars, exchange rates, and monetary policy. So very much looking forward to that. And so please join me in giving him a warm welcome.
Thank you for the kind introduction. Global imbalances and vehicle currency is missing there, so there is so much more. AI. So unfortunately, curb your enthusiasm. I will not talk about everything. So it is I'm very pleased to be here. I should come to the ECB more often, I guess. I missed the dialogue with the European Central Bank on theory and empirical policy issues. I take this opportunity to recap what I did on the monetary stabilization of tariffs. Perhaps not because they are the main determinants of the inflation and output trade-off, but because they're present in the ex post sense, with surprises. Sometimes the announced tariff is not what we see in reality, and also creating a general sense of discomfort and uncertainty, which is relevant for the dynamic. So let me go. I just put a few graphs that I don't want to talk much about. There are some papers now looking at taking a historical perspective. The reason why I like this kind of graph, because when they try to do analysis with narrative extraction of shocks, and when you try to do analysis of the transmission of these shocks, you find very interesting differences across times. And looking across the samples, which is basically before the World War II and after World War II, you see real exchange rates responding very different, and even the current account responding very different. And if you think about what changed, many things change also within these large samples. You can think that there is more trade in manufacturing. There is also longer production chain, and there is also more monetary policy, right? There is monetary policy has gone a long way from the gold exchange standard to modern. And what you can see, the response of to these shocks show up in the way central banks set rates. And so this is what I wanted to show you, that there is a sort of a difference, as long as you can trust this narrative identification, there are systematic differences. Maybe if this new world goes on, we should spend more time looking at different samples, try to extract determinants that interact with the decision to stabilize the economy. This is a premise. It's a wishful thinking, like something I would like to do more. And I go to more recent history when, after Trump won administration, Paul Bergin, we were sort of sitting down and thinking of looking at papers written by the Fed at the time. And the papers written by the Fed were carefully executed, except that they look at the transmission of tariffs assuming a standard Taylor rule. And it was not convincing at the time. No, like the first quick and dirty assessment of the transmission of tariff was done using a standard Taylor rule. So we start to think about what is a tariff, different from VAT because it's selective on imports, different from a productivity shock, different from a markups. The revenue accrues to importing country, right? While the markups accrues to the producer. And most important is levying on importance over the border price. So it's a flexible adjustment of price. You know, if you think of the nominal rigidities on the border price, a flexible adjustment. So it cannot be that the standard Taylor rule is a good thing. It cannot be because it's not suitable. So we started to think, okay, let's write a model tracing the effect of the shock on productivity. So you want some kind of roundabout production. You want to have some element of cost push, also in the dynamic adjustment of wages and CPI. We may want to have a misallocation across sectors because tariffs sometimes go into different sectors, some of them closer to homogeneous goods, some of them close to manufacturing. This is something that I didn't do, but people at the Bank of Canada, Luhan has, is this paper in which you look at the transmission across several layers of nominal rigidities, going from border price production, wholesale, retail. And when you do that, you start to think what is the synchronicity of the price adjustment. So it's actually an interesting research project. And especially for me, relative price misalignment, the exchange rate. So what we do, we say, okay, let's have a look at tariffs that can be unilateral or reciprocal, can be persistent or temporary. And we would like to control for the share of intermediate inputs in production and then try out different assumptions about nominal friction. So what we came out is a paper written for the JE in which basically we're saying that PPI stability is better than CPI-based Taylor rules with some smoothing adjustment on the output, but still welfare dominated. And there are two simple messages. The first one is that in a trade war, basically there is a global contractionary shock, which calls for expansion unless the share of intermediate inputs is very high. And for the US would be well above the level of estimated intermediate inputs using input-output. So we wanted to say in a trade war, actually, the expansion, the motive for expansion dominate using Ramsey policies. In a unilateral tariff, what you want to do, you want to correct the relative price distortion. So you want to have a relative contraction, relative on contraction. You want to have more expansion at home, or if you want, more contraction at home if you want more expansion abroad. After we published this paper, the literature went heavily on the contractionary effect on tariff. And they move away from the two-country model. They go from a one-country model. And all the attention was based on this idea that we want to have a contractionary effect also with a unilateral tariff, which was funny because our paper was not a contraction, it was a relative contraction. So actually, if you look at the input responses, you can have a relative contraction with both countries being expansionary. But the whole point was how contractionary are tariff. So Coulibaly-Bianchi came out with this general idea about fiscal transfer. If you have a tariff that is ad valorem, when I buy an imported good, I may miss that I'm increasing the transfer from the government through the tariff. So there is an externality that creates a motivation for pushing using monetary policy of pushing demand up. There are elasticities. Now, everybody taking a class in international, they know that the trade elasticity, the complementarity comes from a combination of intratemporal, intertemporal elasticities. And indeed, Auclair and others tell us this, that you have sigma is intertemporal, intratemporal elasticity, so you have a sense in which enough complementarity can change the transmission of tariff, making it more or less, more contractionary. There is this idea that tariff-induced uncertainty is contractionary, both for investment and consumption. And there is a beautiful paper by Alessandria, the sort of flex price, So forget about monetary flex price. Look at the use of tariff revenue. And it comes with a very anti-Trump result, which is to say, if you use the tariff revenue to grant a tax cut on capital income, that is actually bad. And the reason why it's bad in the model is because there is a lot of monopoly power in capital. So when you give a tax cut to capitalists or to capital income, you are basically feeding rents. No, you much prefer actually a subsidy on investment rather than a tax on capital. So this is the debate that I could see, but there is much more. There is like Smith-Grebe, they look more on the... all I'm saying here is the fact that this contraction effect has become the dominant thing. And I would like to sort of change perspective, and instead of looking at just a contraction, let's talk about the change rate, which is the role of the misalignment, of the relative price misalignment in the stabilization. How much is important for central banks? So, and the idea is that you can have an adjustment in the change rate that sort of moderate the effect of tariff on the distortion of the demand in the countries placing the tariff. But as we see, ultimately, this may require some kind of cooperation or like at least no strategic interaction between the countries involved. And I sneak in from the window of the talk a new model. So maybe at this point we have new Keynesian model or open economy model with one tradable in each country, perfect stabilization. We have a model with tradable, non-tradable, or we have a model with zillions of sectors in which out of enormous input-output, thinking is buried. So there is too much information and you don't think. So let's do step back, go for two sectors, one more manufacturing with nominal rigidities, one more towards homogeneous without nominal rigidities. And use this to basically, so the sector heterogeneity buys me the fact that if you look only to the manufacturing, you get the standard model. Once you add the more competitive sector, you get dynamics that is reminiscent of trade model, and especially a great paper by Bob Lucas about the change rate determination that maybe many people may have forgotten. So what I say in the rest of the talk is the fact that if you look at Ramsey optimal allocation, with a tariff of manufacturing, which is the sticky price sector, you still need a relative home contraction. This relative home contraction at home may be expansionary or contractionary, depending on the elasticities. What is important is that there is this difference. And if you do a tariff on the flexible price goods, think of commodities, think of steel and aluminum, what happened there is that you actually want a robust monetary expansion for reason that you want to basically counteract the effect on the change rate that is hurting the price competitiveness of your manufacturing. Okay, so you put a tariff on steel, there is an appreciation. You would like to avoid that. So the central bank appreciate to avoid killing the price competitiveness of the manufacturing sector. What is different between these two things is that the tariff on manufacturing, so the tariff, let's say, on German cars, call for European expansion. So most of the action of this relative price adjustment comes from the country that is targeted by the tariff. Okay, so tariff on German cars, Euro area, tariff on European cars, Euro area expansion, tariff on steel and let's say steel and aluminum would call for more for a US participation, US expansion. So let me show you. I'm going to skip the model. I have it in the slide. The slides are also in the paper with Bergin. So we have a differentiated goods sector with monopolistic competition, sticky price, endogenous firm entry, roundabout production, and a non-differentiated goods sector with perfect competition, flexible price. It may or may not be homogeneous. It can be some kind of elastic substitution across different varieties. It's important to look at ad valorem import tariff for something that I'm going to tell you in a second, and money is rebated to households. So this is just for notation. C is consumption, D is differentiated, N is non-differentiated. Diff comes in different varieties, which actually we have a model with endogenous entry. So N, we have endogenous differentiated good variety, while the non-differentiated good is, we forget about entry. Clearly, the elasticity of non-differentiated is higher than the elasticity of the differentiated good sector. Price index, remember, you will have a tariff coming out that can be differentiated between tradable and non-tradable. Tradable and differentiated and non-differentiated. And basically, what happened with tariffs is that most of the demands functions are the same, except that you are aware that the tariff will change the composition of demand, obviously, in favor of home, when there's a tariff on the differentiated good at home will be more good at home, a stronger demand for home differentiated, and the same thing for the non-differentiated. We will shift the demand. And of course, the output. So household is standard. I just skip over it because you are not very, this is also standard. Since there is sticky price, you just need to keep track of all the use of resources, including also, there is an iceberg cost on trade. There is an element of trade theory in the model, so you need to be acquainted. Okay, so what is important is the non-differentiated goods sector. Because the non-differentiated goods sector, basically with flex price, brings in a low one price that tightly links the change rate to the price in the non-differentiated sector and the tariff. Okay? This is can be monopolistically competitive, but especially in competitive sector, you will see that this links the price to marginal cost. In all these elements, you see, like this is, in this page, you have these equations and the foreign counterparty. And this low one price that sort of suggests that the change rate is completely determined there. It's completely determined in the competitive sector. As long as you are within the cone of differentiation, or as long as that good is produced in both countries. As long as this good is produced in both countries, you see, like you have an exchange rate that is determined by price, indirectly by wages and productivities, and that's it. So to make the story clearer, I go actually for a model that you can solve very easily, pencil and paper, by basically using a Cobb-Douglas aggregator, very open economy. You can actually, you could have home bias here as long as it's symmetric, if you also have logarithmic consumption. So these log linear preferences here. So I assume this utility function, Cobb-Douglas, and instead of doing Calvo-Rothenberg, I do one period preset prices, which are easy to deal. And remember, in this model, the mu, the multiplier to the budget constraint, is what you call monetary stance. Basically, it's a sufficient endogenous variable that completely captures the monetary stance of the model. And with log utility is basically exactly equal to nominal spending. The wage rate in the equation for the equilibrium in the labor market will be equal to proportional to mu. Okay, so I'm going to present very quickly 4 or 5 results to make my argument. So the first argument is Lucas' whole paper saying that all this fuss about the change rate, once you produce the same good in both countries and is competitively produced, the change rate is determined there. That's it. This is it. So if you have the production prices equal marginal cost, you can substitute the equilibrium in the labor market that tell you the wages is equal to nominal spending. You have that for the 2 countries. You use the low one price. And again, as long as you produce the same good in the 2 countries, you can have conditions that determine when you exit the cone of diversification. You have this equation that completely determines the change rate. So the change rate is determined by the ratio of productivity in the non-differentiated goods sector, the ratio of monetary stance, and the tariff. Notice, no tariff in the differential, no tariff on cars there. No productivity on cars, just productivity in the competitive goods and the tariff on the non-differentiated sector. You see the change rate appreciate when you impose a tariff on, so the US dollar should appreciate when you impose a tariff on the steel, let's say steel and aluminum sector. So that means that there is a spillover, right? So you put a tariff on the aluminum and steel, the dollar appreciate, the car manufacturer in the US are annoyed because they lose price competitive given the price stickiness. Okay, so this creates, of course, an issue for monetary policy stabilization. Of course, you also have an effect, a distortion of the tariff that goes into the relative demand for the differentiated goods sectors directly, but doesn't pass for the change rate. The change rate does not react to the tariff on manufacturing. Okay, so this is the monetary policy issue. There is not much we can do for the flex price sector, the non-differentiated sector, but there is this spillover on the other sector that may require stabilization. So, result 3. Remember, the tariffs are ad valorem tariff to a large extent are non-markup relevant, markup irrelevant. So when you solve for the Phillips curve, when you do the optimal pricing, you see, it's interesting because this is a very simple example in the model. The price, the sticky price that you preset one period in advance as expectation of these terms, that is basically the quantity that you sell that determines the revenue and determines the cost, this red term. The difference between the right and the left-hand side is that P loads on the monetary policy through the marginal cost, which is this term, expectation of K and the expected marginal cost, and the optimal markup. So this is the Phillips curve that you have been, you can do with Calvo, is the same thing. Expected revenue equal expected cost, discount in case of Calvo, multiplied by the equilibrium markup. So you see, what is interesting there is that if you don't move the marginal cost, these two terms cancel out. So that means that if you expect a tariff coming, the optimal preset price does not move. It's not a function of expectation of the coming tariff. Again, because it's the ad valorem tariff, so in a way, it doesn't feed your markup in a way. It's not markup relevant. But on the other hand, if it immediately tells you how you can affect the preset pricing, which is any monetary policy rule that creates a covariance between this tariff, this productivity, and the marginal cost, that would change the pricing condition. And in particular, if you can have a positive correlation between the monetary stance and the tariff shock in the other countries, you see like the positive correlation between mu and the TED star, then you have a situation in which you can affect the level of price in the catalog, not the preset price ex ante. And in particular, you can basically, if you systematically depreciate in response to a tariff, sustaining demand, that is going to affect the preset pricing by lowering the preset pricing. This is the other result. If you solve for the cooperative policy in this model, you get the monetary stance in the two countries. By the way, in this particular case, it's also the same as Nash. It's a result that I derived with Paolo Pesenti a long time ago. Is the correlation, and Nash is the same thing, this particular specification. You have monetary policies that are basically responding to the tariff, to the differentiated good set by the other country. Clearly, if I sit at home, I need to take care of my demand, and I respond to the tariff on the cars, on differentiated good set by the other country. I also respond, of course, to the tariff on the non-differentiated good, because we saw before he has this effect on a exchange rate and then a spillover on the demand for the sticky price good. So you see that one of the results of this model is that this is a sharp result. Basically, what the optimal monetary policy completely stabilizes the right-hand side of the optimal price equation. So basically, the optimal rules equates marginal cost to basically a constant. So I think there's a mistake here. He basically kills the right-hand side of this equation. He makes it a constant. As a result, he creates actually a link between the optimal perceived price and any expectation of tariff, no? Because people know that the central bank will react to tariff. Okay, so will determine an uncertainty that will go into the optimal ex ante, if you want, markup over expected cost. So, you can have this term that basically tell you that under the optimal policy, anticipation of a foreign tariff, which is also anticipation of the reaction of central bank to foreign price, tend to increase the perceived price. Of course, in domestic currency, which, remember, you do that when people expect that you react to the tariff by expanding, right? So you increase the perceived price on your catalog in domestic currency, so ex post, when the tariff comes, the expansion will actually create price competitiveness abroad. Now you have a depreciation coming. So this is basically a very sharp result from the model, which tells you that if you put all these things together, you have this prescription that in a cooperative sense, in a global welfare perspective, whenever there is a tariff on a differentiated good, whenever home put a tariff on a differentiated good, most of the action comes from the other country. The expansion will be important to keep its demand up and redress the relative price. And in this particular case, you can have this effect. So basically, you have a wiping out effect. So the change rate appreciate to wipe out around 50% of the increase in the CPI price in the country that imposed the tariff. If you impose a tariff on the aluminum steel, you have this share response. Your monetary policy, the foreign monetary policy, you just prevent any change in the change rate, so to insulate the sticky price sector for any spillover effect coming from there. Okay? So, pencil and paper, you do a model with bells and whistles, you get almost exactly this. Almost exactly this. I'll show you in 5 minutes. So it's an amazing kind of message. Number one, it may be good to look at the sectoral composition of tariff. Number two, we may come to term on a change rate movement. Clearly, the change rate movement you cannot test independent of monetary policy. So there is always the issue of extracting the direct effect from the equilibrium effect. But the implication is basically, in the trade-off between output and inflation, there is this third element, which is the redressing relative price and sectoral allocation, which calls pretty obviously, if you impose a tariff on the foreign better expand, differentiate the good. If you impose a tariff on aluminum steel, you may have an interest in reducing the change rate response, using the monetary policy to reduce the change response, exactly not to disturb the equilibrium in the other countries, in the other sectors. So, as you know, these results are predicated on full pass-through. If you go into partial or no pass-through or dominant currency pricing, we know already what's going on, in the sense that you go from an exchange rate that helps you stabilizing relative price to an exchange rate that moves around the markup and income. So you sort of switch the optimal policy from focusing on the exchange rate and the demand through price competitiveness through stabilizing income. And this is a neat result in which basically tell you that if you have local currency pricing in both countries, Half of it, you just want to do price stability because you want to have your own goods to be as stable as possible. Half of it, you're actually stabilizing the importers, the exporters. No, you want to basically, you want to focus on the demand, on the CPI. And you do that, this is like many years ago, a result, a generalization of the result on the GME. You have this kind of focus on stabilizing markups and income, and you see this through the level of the CPI. In this case, you have a home expansion. So when I impose a tariff in the case of PCP, all the action was in the other country to sustain demand. In the case of LCP, it's not me. I want to stabilize the demand at home. So I respond with an expansion to my own tariff. And if you do a dollar pricing, you just get the mix. But most important, as we know, dollar pricing usually posits a little bit of it gives an incredible privilege to the country issuing the dollars, but also creates an enormous responsibility. The incredible privilege is that in principle they can behave as if they were in a closed economy and just do basically like inflation target. It's not exactly price stability because you have the tariff, but then like you can just concentrate on your own country. If you have a cooperative equilibrium, there is this mix in which you want to, at the same time, stabilize income and markups in your country, also the exporters, and redress the relative price in the other country. And this is exactly what these things tell you. And as is very well known, Pareto is not necessarily Pareto optimal for the country that issue the dollar to, or the dominant currency to cooperate. You have global welfare, but it's not not necessarily Pareto for the country that issue the currency. So to just very quickly, I go to the full model with calibrated to the US and the A. There is nothing strange in the parameters value. We have tariffs that are temporary, so there is a tariff uncertainty with some persistent, actually not so much persistent because here we use, in the baseline, we use Barattieri et al. And what you see here is the fact that if you have an optimal currency, an optimal Ramsey policy, cooperative Ramsey policy, you have some gain relative to the case of doing just a Taylor rule with smoothing parameter response to output. There is some gain, and that is distributed into two countries. One thing I want to call attention is that the distribution is, tends to be in favor of the home country that imposes the tariff, but not necessarily. Like there are cases of reversal. Like for example, the persistent tariff is actually all in favor of the other country in terms of relative gain. And here you have all the difference. You can start to play around with complementarity, with elasticities of various types, persistence of tariff. You can play around with the PCP, DCP, or LCP. You get a result that more or less show you that there is an uncertainty component. Those are like gains, including also the transition. There is a sense in which you can do better by not doing plain CPI-based Taylor rule with a smoothing parameter on the interest rate and response to output. And gains are lower relative to PPI. So if you actually do domestic price stability, the delta of optimal cooperation is not great. And you see also more clearly the fact that sometimes the home countries are actually losing. The home country is losing because of especially in the dominant currency case, because it needs to create, address spillovers in the other country by deviating from what is optimally in an inward-looking sense. Okay, so this is more or less the picture of what the premise. I want to make a small announcement here. With Martin, so some people say, okay, this is two countries with global cooperation. haha. No, we don't see that. So number one, I'm not sure. Because, you know, in a way, monetary policy, you still see each other, despite you talk. But then where is Martin Bodenstein? We had this result that is coming that actually, remember, if we show that if you delegate monetary policy to people with slightly different preferences than the president, Trump, meaning they have some preference for the rest of the world, like 80-20, no? And markets are sufficiently diversified, you have an equilibrium that is close to cooperation. And the reason is the fact that anytime I try to take advantage by deviating, first of all, you know, I feel Luke is crying, so I feel bad. It's not, you know, I feel that I'm taking advantage of him. And second, financial markets are redistributing. Okay, so to be concrete, if the Fed does something bad, banks are unable to Europe, maybe Powell knows us very well and say, I don't like that. On top of that, we own a lot of equities in the US. So much of the gains come from us. So this gives you an equilibrium that is close enough to cooperation. We hope to publish this paper in the next 45 years, given the multiple demand on policy. But it was for us very important to know that, because sometimes people say, why do you do cooperation in monetary policy? There is a sense in which the idea of delegation that comes from Ken Rogoff, no, you want to delegate a central bank that has different preferences than the average. It applies also in the international context in a way that can be very good for, you know, meeting and trying to find out the monetary policies that are actually good for the global stability and global stabilization. So let me go quickly to tell you how the model, remember the little model that has all this very sharp result? You do the big model, you find the fingerprints of the small model in a way that is almost embarrassing. So this is the transmission of a unilateral tariff in a model with roundabout production, all the nice things that you can think of, under a PPI targeting rule that is basically reproduces the natural rate under PPP, under a PCP. Now with full pass-through, you have natural rate. So you have a unilateral tariff of the home country. The home country has a contraction with some inflation. The foreign country also has a contraction with some inflation on impact. But you also see there is also a very interesting distortion in the allocation across the two goods, differentiated and non-differentiated goods. Okay? And there is an appreciation of the exchange rate that comes not from the tariff itself, but from the PPI rule, no? Because there is a response of monetary policy there to keep the PPI completely fixed. So when you go into a Taylor rule, the Taylor rule sort of, it is like the ... relative to the dash. It sort of gives you, because of the smoothing term on the interest rate and because of the interest in smoothing also output, gives you attenuate the fall in output in the home country that imposes the tariff. So there is a little bit of a change in the cyclical, but also attenuate the home exchange rate appreciation. So there is a sense in which it goes in the direction of expanding, attenuating the interest rate, the exchange rate appreciation. And you see like the home PPI indeed is very strong and the foreign is falling. When you go into the optimal rule, you see this reversal of fortune. It is the foreign, remember, it is the foreign country that needs to take care of the level of demand and attenuate and change the exchange rate. So there is this big expansion. It goes from contraction in PPI terms, it goes expansion in PPI terms, and you have more action on the exchange rate that redresses the relative price distortion. And indeed also changes the sectoral reallocation. It contains the sectoral allocation from the tariff. So this is, I think, is an important message also kind of a research project to try to understand the composition of the tariff and this aspect of relative participation, no, in redressing the relative price distortion. So this is just to take stock. Under PPI, in a natural rate allocation, you have the inflation, stagflationary shock. Tariff reduces output and increases inflation, gives you too much sector allocation and dollar appreciation. With the Taylor rule, with a smoothing parameter, no? If you are like more in the mood of wait and see, let's look at the data and whatever, at this point you could go for, in a way, excessive. So you swing from having an optimal participation of the foreign country through an expansion, you're redressing the stabilization problem, to too much action in the home country. So there's too much, too much excessive expansion in the home country. Okay, so there is this kind of message that basically, in a case of unilateral tariff on the differentiated goods, is the rest of the world that sort of has the incentive, at least the theory tells you, as an incentive to participate more in the stabilization. Many of the papers start, Berg and Corsettin are wrong because they are contractionary. I mean, there is no contraction here. Just you need to publish, so people need to be very good. But there is a confusion between relative contraction and absolute. No, you need to sort of write the model in a complete set of equations. And it is true that there is something different between a small open economy and a two-country model. With the small open economy, you kill much of the action on the exchange rate and the effect of the exchange rate on the relative price. So this is it's a question of a choice. If you look at the US and Euro area, I guess the two-country model would be more appropriate, just to think more about the aspect, the component of the exchange rate in the loss function and the optimal monetary policy design. Okay, so the DCP, you see, like if you look for the dollar pricing, any kind of inward-looking policy would tell you, would give much more weight to an expansion, let's say in the US, than the optimal policy, exactly because there is this kind of call for the US to come and rescue the global economy through an expansion, through a policy targeting also the relative price. So you see that it is an expansion relative to the PPI policy. There is this combination of home expansion in the home country and basically almost PPI stability in the other country. Remember, one of the standard results when you do dollar pricing is the fact that for most countries, what you want to do, you want to stabilize. Let's say you want to stabilize nominal marginal cost in domestic currency, which is close to PPI. While most of the action in the stabilization of relative price and the global economy comes from irresponsibility of the country at the center of the system. This is an example where you put the tariff on the. Is this the time remaining is for the whole team or only for me? For you, okay. So because I want to leave space for questions. So the case of the tariff on the commodities, again, remember there is this issue that per se the tariff on the commodity appreciates the currency, but has no effect. There is nothing one can do for monetary policy in a system, in a sector that is flex price, but it has the spillover of the exchange rate on the other sector. So again, you have, with PCP, we have exactly almost the same result as in the other tariff. Much of the action comes from the foreign initiative, but this time as the opposite sign. No? Instead of an expansion, you want a contraction, because you want to basically come together and avoid the appreciation, the excessive appreciation of the dollar to minimize the spillover on the sector, the sticky price. So if you compare the PCP, most of the action come from the foreign in terms of an expansion. In the case of dollar pricing, in the case of the tariff on the non-differentiated good, most of the action comes from the foreign policy, but in this case, of a contraction. Okay, so to conclude, perhaps we should think more about the change rate, the role of the change rate in this stabilization game. You cannot use one open economy model. There is a price for it. You don't get the action, complete action, or in terms of exchange rate misalignment and relative price misalignment. I would say that given the fact that we have input-output, going from one good model to 150 sectors, there is intermediate steps one can take and have a principle of categories, like which sectors are more flex price, which sectors are more forward-looking. We can try to differentiate the type of sectors we deal with. And in that case, you will get this kind of result that a tariff on the sticky price, you act on it directly. A tariff on the flex price sector, you have to act indirectly. Sometimes the prescription is exactly the opposite of what you get in the sticky price sector, in the case of the sticky price sector. So you may ask the question, so but what is the evidence? Now, one of the problems, so there are two things. With Daniel Ostry and Simon Lloyd, we tried to do this paper looking at the transmission of shocks in the first Trump administration, second Trump administration. And what you see there, that one of the problems of working with tariff is that you need to think of what happened in the rest of the world. And we thought that we found a nice way to calculate input responses for tariffs that are unilateral and tariffs that are retaliated against. There's been a little bit of discussion whether the identification is good or not, but the results that we get are pretty much in line with what you expect. You have an appreciation of unilateral tariff of the US, of the dollar, and you get basically either nothing or a depreciation when the tariff is retaliated. So any exercise we do, we need to be careful because, basically, especially in the sample where we had the WTO acting, many of these tariff shocks, depending on how you calculate, are actually progress in the WTO liberalization or application of WTO rules. So there is always a global component, that's what I'm saying. And in the case of the 2025, there is something different, of course, which is the fact that relative to the previous case of the Trump administration, the dollar still goes the way you think. So respond to a tariff with an appreciation, but there is a large difference in the response of asset prices like the 10 years or longer bond yields, two-year bond yields. So it's a different nature of the shock, that's what I'm saying. So also this gives you yet another complication that may blur the sharp application of what I said so far in terms of what you do when there is a tariff. But that is the caveat. I just want to tell you that perhaps we should also think as a sample for empirical work, what happened when one of the two countries fix the exchange rate. This would be relevant for the euro area neighbors. So you can actually use the small models. This is in a small appendix here. You have still a very sharp prediction for the pencil and paper model that you can take to the input responses. I don't go to talk about this because it would be too long, and I've already been trying to confuse you with all this algebra. But I guess the result have been clear what I'm saying, like the fact that there is a sense in which the answer, the question, is a tariff going to be contractionary, should be a little bit rephrased in terms of is the tariff going to be contractionary, distort sectoral allocation of consumption and output, and distort relative price in a way that is a bit richer than the two output model. So that will create a little bit more of a dynamic and food for thinking. Let me stop here and get questions or comments.
Right. Thanks so much, Giancarlo. So the floor is open for any questions. I'll start here with Matteo.
Easy question.
Please.
Great talk, of course. There are two things I would like to hear your thoughts about. When one thinks about a lot of tariff shocks, they are never tariff shocks. It's always news, and it's always news with a probability that it may happen at some point in time, or it may not happen. So that's obviously has a large impact on what asset prices do, exchange rates do, and also how macro variables react. And relatedly, most large tariff shocks, okay, I see how they work in the model, but obviously in reality, they trigger, especially when I think about what Martin was presenting earlier, like there's a lot of other things happening at the same time as there are tariff shocks, and they obviously trigger reallocation of capital. They trigger rethinking about, say, the fiscal position or the fiscal strategy of a country. So obviously, a lot of the effects you see from tariffs to exchange rates, they may be actually caused by tariffs, but they may not only work through the fact that tariffs change the relative price of goods. There's much more than just that. So I'm curious to hear your thoughts about that too.
I'll collect 3 questions. Is that okay?
Yeah.
Good. Next up is Anusha. There, penultimate row. Anusha started today as a Duesenberg Fellow here at the ECB. Please come and see her on the 8th floor.
Thanks, Luke, and thanks for the keynote. So I'm just thinking about the U.S. economy in the aftermath of the Liberation Day tariffs, and you were getting to that at the end of the talk. So there's some facts, right? So we've seen pretty robust economic growth, 2.1% in 2025, forecast to be 2.3% by the IMF in 2026. At the same time, we see inflation ticking up, coming in at about 3.5%, and a dollar depreciation against an advanced economy area like the euro area. So I was just wondering, how should we think about optimal monetary policy given these facts in the context of your model?
Okay, and then the third question, Leo, here on your right. And then I'll collect another round afterwards. Okay.
Leo von Taden from the ECB. So thanks a lot for this super interesting presentation. But I have one specific question, namely whether you could clarify a bit more exactly the strategic game that is played here. My understanding is that in most of your talk, you assume there's a unilateral, one-sided increase in tariffs, and then given this, very interesting results on cooperation, non-cooperation between central banks with interesting nuances. But in case we want to map this into the, simplifying a little bit, the situation between the US and Europe. In Europe, there's not only the ECB, we also have the Commission. So, and the Commission is in charge essentially of thinking about responses in terms of tariffs. So isn't there an underlying game how we address the tariff war, which is settled, where the ECB shouldn't have a role? And given this, then we think about a monetary policy response to all this.
Okay. Yeah, very quickly. So Yeah, like the tariffs trigger a lot of stuff, a lot of allocation. I completely agree. We need to think about the fiscal and whatever. What I'm saying is the fact that so I just wanted to show an ex post effect of tariff that is feeding the ex ante simulation of the model with all the result. So in a way, it is modest, but it's not, in the sense that you just want to go into this complex question by having a precise grasp of what's going on from the tariff itself. So I completely agree. There are lots of other things happening. And in particular, something that worries me is the following. I don't think this tariff will have, so the impact per se, the transmission on tariff and GDP can be modest. Also the answer to Anusha, this is not where the action can be, at least because there is so many other things going on. What worries me is actually what happened after the dust of the reallocation and recombination of production chain is gone. And in particular, I would like to assess what is the effect on the concentration of market. I mean, if you look at the long-run effect of this, suppose that we go into a higher tariff world, recomposition of value chain, technology will help increasing the elasticities of substitution. So many of the stuff will be absorbed by the. What will not be absorbed maybe is the fact that we'll have segmented markets nurturing concentration. And since concentration now has become shamelessly the provider of money for politics, we may go all the way to a world in which basically big actors, thanks to this segmentation of markets, will have even more firepower to get sort of this two-way sustaining rents and political rents and economic rents. So again, you should not read too much in this particular. This is one element. Also to Anusha, there is many things going on. When I try to do literally what is the transmission of tariff, there is not much there, as we know. It's more the policy and the dynamics that come from also many other stuff, including technology, including investment and everything. The strategic game, this is monetary. I'm talking about monetary, but I take this thing as given. It is fully random, the model. Like, you know, when we simulate the model, we have several different scenarios for the game that you have in mind. We don't do that. I just want to make this point that in a world of increasing geopolitical fragmentation, one of the questions is whether the community of central bankers will keep some rhyme and reason. And as a matter of fact, I'm writing a paper with Emil about the tariff diplomacy, whether we need a change in the objective function of the monetary policy. I hope not. But there's also this question of whether the community of central bankers can keep some kind of cooperative spirit, which is basically mostly justified by your mandate. I mean, your mandate is not to make the global economy well, but there is an element of common interest there that can be easily internalized. I know it's frustrating, my answer, but your question is even more frustrating. So too many things going on. Should we go another?
I mean, just to clarify, the mandate is very much national in spirit.
No, completely. But remember,
events like this are more in the spirit of cooperation.
Sure, but when I say like this, like remember, we already done this, no, with Rogov, like this idea. So nobody says that people should be naively interested in the global welfare. Just saying that there is a smart way to pursue national interest that may take indeed in the simulation that we did on cooperation with Martin and Luca Guerrieri, where we asked the question, would you like to keep cooperating or not? We have sometimes even like a mixed result in which conditional state of the economy there could be an interest, in keeping internal S&P lower.
I think those results are interesting because even if you have a national mandate, of course you take global inflation as an input.
Yeah,
so
exactly.
So this way it gets closer to cooperation in spirit.
No, this is exactly what I'm saying. Like
So
there is a sense of noticing that.
Good. So we have, unfortunately, time for only one more question. Can you pass the microphone here up front?
Thank you. So Martin Bernstein from the Federal Reserve. Quick question on, so in the Bianchi-Coulibaly world, there is this, because of the small open economy, the terms of trade are taken exogenously. And so any tariff in that world is clearly welfare deteriorating. And so, but in your world, and this I think goes back to the question earlier, so if you start from a zero tariff, in many of these models, actually a unilateral tariff can be welfare improving. So is there any sense in your world of how how the responses that you see depend on sort of the initial tariff base that's stated in there? And the other somewhat related issue is a little bit on the persistence of the tariff. So, I mean, I think it was clear in your world that the tariff is temporary. There's sort of a mean reversion to it. Because a lot of these results can very much depend on that. And again, a lot of these other contributions have assumed permanent tariffs, which probably also in light of Matteo's comments are, I think he made a nice description of how probably we shouldn't see them as permanent. And so maybe you can lose a few words on the role of the international financial flows that helps with smooth tariffs and how you see that ability to smooth any of these kind of shocks through financial markets affect sort of the results that you see. Thank you.
So I have two comments on this. The first one is that once you start looking at optimal tariff, you immediately run into the plethora of questions that is cocky-mookie. Now they're trying to look at whether or not, depending on it's actually our joint work, depending on the position on the external debt. The other thing I want to stress is that this model does not have the optimal tariff only. It has also the home market effect. And there is, so if you are in trade, the Hossa, Rafael Hossa paper on the tariff, so it's basically reflecting the debate in trade. So trade, there is this idea of the optimal tariff as intervening on the monopoly power in terms of trade. But there is also another theory, a little bit less discussed, which is the production relocation externality. So this is a model with production relocation externality. Actually, the tariff that you want to impose doesn't go into the terms of trade per se. It goes into the fact that there is an interest in having, so suppose you have two sectors. One is, let's say, more value added, the other one less value added. Could be, for example, if you pay, if cars, you pay efficiency wages. Now there is more value added there. So there is an interest in the country in producing more, no? In shifting. So in this kind of models, actually, the reason to put the tariff is not so much the monopoly power in terms of trade, but to try to get as much as possible, to use the home market effect, not to increase the availability of intermediates and goods in your own country and then ship it outside, no? Like, and make the other guys pay the transportation costs so they become less productive. So what I'm saying is that when we talk, I mean, I'm happy to go into this optimal tariff game and whatever. Our models, not even the world, but even our models are richer. So maybe we should pay attention also to this second element. This model has the production relocation externality that is much stronger than the effect on the monopoly power in terms of trade.
All right, so I need to close here, unfortunately. Thank you very much, Giancarlo. Give him a applause. Okay, and so then we move to the next highlight.
Lunch.
No, it's not lunch. It's not. That's a low light. We have the young economist session. I guess that's a way for the organizers to tell me that I'm an old economist. But the way I look at this is the future of research. So we get, no, we get, so I'm asking the three young economists, wherever they are, to come join me on the stage. We will rearrange the seating. And please remain seated for this event. So Chiara, Alexa, please come on all here. And I think we need maybe one or two more. This is not yours, don't drink from here. Okay, so welcome now to the Young Economist session. I have three bright young scholars flanking me here from both sides of the pond. And we will start with Alexander, after that Ethan, and last but not least Chiara, who actually, for anything that she's going to say that's wrong, I'm to blame because she was one of my former trainees. So I'm very much looking forward to her talk here today. Now, so the rules are 15 minutes each, and then a couple of minutes for Q&A. So we go one by one. And please ask questions. So, Alexander, the floor is yours.
All right, thank you very much. So I'm Alexandre, I work here at the ECB, and first I would like to thank the organizers for putting the paper in the program. And so the papers joint work with Emmanuel Gastegayer, Alex Grimaud, Gauthier Vermondel, and with Guido, who's in the room. So if you have any difficult questions for him, I think he will be happy to answer over the lunch break as well. And so since some of us work in Eurosystem central banks, the usual disclaimer applies. And so the paper is entitled Monetary Policy in the Euro Area when Phillips curves occurs. And so the motivation for the paper is the following. So before 2020, there was a relative consensus that the Phillips curve was flat and quasi-linear. And what that meant for us, practitioners, was that typically when we estimate our favorite or calibrate our favorite sticky price, sticky wage model, we tend to use what we call the high Calvo parameters. What it meant, in other words, is that we were going to assume a constant, relatively high parameters for the frequency of price and wage adjustment that was going to lead to infrequent changes in prices and wages, and that was in turn going to lead to a slope of the Phillips curve that was rather flat. And this had implications in the sense that typically, even if it's, let's say, solved in its nonlinear form, the standard sticky price, sticky wage framework was going to be close to linear and state invariant, such that the shocks and the transmission of those shocks were going to be non-state sign or sign dependent. So in particular, we didn't have any features such as the fact that large shocks were going to travel fast for supply shocks, nor the fact that, for example, monetary policy state was going to be state dependent. So the transmission of monetary policy was broadly state invariant. And so since 2021, so both assumptions were actually challenged. By both assumptions, I mean the fact that macro evidence pointed to non-linearities in the inflation dynamics, and the second one was that there were micro evidence showing the fact that as inflation increased, the frequency of price and wage adjustment was going to increase as well. And so that's where this paper comes in. So our goal is to connect those macro nonlinearities, and in particular to look into the role of endogenous price and wage adjustment frequencies. And in particular, our goal is to look into that question and to understand the impact that it had for the area over the recent inflation surge, and in particular as well for the state dependence effect of different type of shocks, as well as the way the inflation output trade-off is going to change for monetary policy. And so we do that in three ways. First, we build a framework based on some work from two of my co-authors that is going to be a non-linear new Keynesian model with endogenous price and wage adjustment frequencies. Second, we're going to take that model to the data and use a non-linear Bayesian estimation for the area using an extended path and an inversion filter. And finally, we're going to look into, so to use that model in order to look into some quantitative analysis for the recent euro area inflation surge. And in particular, let's say the message that I'm going to try to convey in the following 6 minutes is that there was a role for both price and wage state dependency to the recent inflation dynamics, and that also those factors change the way shocks actually transmit, and hence the stabilization trade-off for monetary policy. And so in terms of the model, I will be light on equations, so it's really just a standard new Keynesian model where we have a representative household, a Taylor rule, and really the core of the mechanism is going to come on the price and on the wage side. So on the intensive margin, this is just as well standard, so we just assume that there's going to be firm and unions that choose the optimal reset price and wage. But the key novelty here, I mean, the key difference that we introduce is really on what we call the extensive margin. So typically in a model, you will have a Calvo as a parameter. What we do is that we assume, I mean, we construct a model where there is an endogenous share of non-resetting price and wages that comes from this complicated logistic functions that actually only has two main inputs. The first one is what we call the value of resetting prices, that is V sharp here. And this is going to be compared to the value of keeping the price to the old aggregate price or wage. And basically, as the difference between the two is going to increase, you're going to have more incentive to either keep your old price or change it. And that's the way we actually make the frequency endogenous. There are two key parameters. Let me focus on one of the two. So this gamma z really scales the extent to which you have state dependency. So as this parameter increases, the difference between the two will matter more for the frequency of price and wage adjustment. And as this parameter goes back to zero, then the model collapses back to an environment where price and wage frequency are going to be fixed to a value. And so that's on the, let's say, frequency side. What does that mean in terms of macro variables? So why do we get genuine nonlinearity in the Phillips curve that we obtain? So this is really coming from the fact that we get, let's say, the standard Dixit-Stiglitz CS aggregator generate a strong asymmetry in the profit. So the key takeaway is really here that there is a large opportunity cost to being underpriced in that model and more than to be overpriced. And what it means in terms of, let's say, shock transmission is that so in all states of nature, whether it's demand-driven or supply-driven, as long as inflation increases, firms and union in this case are going to have a strong incentive to update their prices or wages. And so that means that there's going to be an interaction between this intensive margin of price adjustment and the extensive margin of price adjustment, which is going to increase in a non-proportional way as price and wage inflation rises. And so finally, that means that Phillips curves are going to be genuinely curves, and as inflation increases, we're going to see responses to shock. They will exhibit state, size, and sign dependency. And so now what we do with the model, we take it to the data, and we do that in a nonlinear way, and we're going to compare different versions of the model in order to run some counterfactual. So the goal will be to look at version of the model where the two, let's say, features that we're looking at, so the state dependency in price and wages will be turned on, and versions where either the two or one of the two is going to be turned off. And so we do so in a fully nonlinear way in order to capture the mechanism that is at the core of our paper with the following solution methods. And then we estimate the model using euro area data from 1999 Q1 to 24 Q4. And we do find in a paper that the benchmark model, so the one where we have endogeneity in price and wage adjustment, can actually outperform the standard Calvo price, Calvo wage model. And now moving to the results. So here we have 4 different curves. So the blue one is really what we call the benchmark. So that's the data that we filter. That's where the both margin are going to be turned on. So the frequency of price adjustment is going to be endogenous. The frequency of wage adjustment is going to be endogenous. And here the key really is to see that if you compare that blue curve to the other curves, so the red one is where price is turned off but wage is turned on. The yellow one is where the two are actually turned off, and then the purple one is where we only have prices. Then in this case, we see that before 2021, there's basically no difference. So even though we allow for price and wage adjustment frequency to be endogenous, both Phillips curves are actually going to stay rather flat. And then most of the action actually comes in after 21. So in this case, if you focus on the bottom left chart, what we call the Calvo share, that's really in the model the frequency of price adjustment, and you see that there is a difference between the benchmark in blue and the purple case in the purple line, which is the case where only the frequency of price adjustment is going to be turned on, and we see that there is a persistent decrease in the fraction of non-resetting prices, meaning that more firms are going to update their prices. That's going to lead to a steepening of the Phillips curve. And now in terms of macro effect, you can see that on the top right, in the case of inflation, that's really this frequency in price adjustment that is going to, that's a lead to that inflation increase that we see in the data. Much more so initially than once we only include wages in this case. And then, so that's mostly, so the initial kick-in inflation is mostly driven by the fact that price reset are going to be endogenous. And then the wage, they're going to play a role towards let's say the final 2 years out of 23. And we see that there's a somewhat reinforcement of the real wage catch-up via the fact that the frequency of wage adjustment is going to increase as well somewhat in the final 1 minute. So that also means that now there's going to be state dependence in the transmission of shocks. So what we do here is that we initialize in each point of our sample the economy to the state at which it is, and then we shock with always a normalized either cost push shock or monetary policy shock, and we look at the transmission. And what we see is that when the inflation state is higher, so that's for example the case of the 2022 Q1 curve here in blue, then the impact of the supply shock is going to be stronger compared to normal times. It's also going to be the case on output. And so finally, in terms of monetary policy, we also see that the same mechanism apply in the sense that as the Phillips curve is going to steepen due to the extensive margin, then monetary policy is going to lead to a stronger disinflation for, in this case, a smaller output loss. And so finally, in terms of the trade-off faced by the policymaker, that means that as inflation increase, so what we call the trade-off here, meaning the ratio between the impulse response of output and inflation, as this number goes down, the cost of disinflating actually goes down as well. It's less costly for the central bank, and we see that as inflation increases, this also decreases as well. And with this, I will conclude. My time is up. Thank you very much.
Thanks, Alexander. Also for sticking to the time. It's hard, 10 minutes?
Short.
That's what we need to do upstairs as well. So, questions? Just very short questions. First, Oreste here.
Thank you. Very nice, Alexander. I just wanted to ask, or maybe even suggest, you don't need to answer it, there's no time, but it would be interesting to see, you haven't said what data you use in the estimation, but it would be interesting to see how fast in the estimation in real time you can capture this change in your indicator of price frequency. So, for example, in the episode that you suggested, whether it moved fast enough to be detected again in real time, or whether you need to wait, for example, until the end of the inflation period to understand that.
Good. Okay.
Okay, so the evidence, well, the results you have shown suggest that prices became more flexible during the recent surge in inflation. An alternative evidence that you have seen in previous papers is that monetary policy became less responsive to inflation. The two will both lead to, a less effective monetary policy. And is there a way through the lens of your model to distinguish these two stories?
Great. Okay, Alexander.
So thank you very much for your two comments. Very well taken and excellent points. So on Oreste, on your comments on the data, indeed, I was a bit too quick due to the time constraints. So we use 4 variables, among which both wage and price inflation. In this case, what we see is that, so the variable that actually matters for the model is quarterly inflation rates. And we see that as soon as that variable is going to deviate substantially from, let's say, the steady state that we have, so the 0.5 steady state that we have in the model for this, then the frequency is going to change. However, so that's not only the size that matters, but also let's say, the persistence of the increase, of the potential increase. So we will typically find that, let's say, as inflation goes up, already, let's say, if we get a push of like 1% at the quarterly level, we'll see already a difference in the frequency of price adjustment, and that would translate into a steepening of the Phillips curve. And that lasts for as long as inflation is above target, and therefore endogenously, as inflation goes back, let's say, closer to the quarterly target, then in this case, we see that the nonlinearity tends to disappear. We also compare those numbers with microdata that we got from Prisma. It's more or less aligned. Maybe the scale is a bit higher in our model, and I think we have a very tiny difference in terms of the timing, maybe 1 quarter, but most of it actually follows through. So on the question the response of monetary policy, it's a very good point. I mean, we have not implemented it in the model. So the way we actually, let's say, model the Taylor rule is via a standard linear Phillips curve where the parameter responding to inflation is fixed. But I do believe that there probably is a way for us, since everything is nonlinear, to look into it further and to potentially allow for either change in the regimes or something else such that we can potentially capture it. Because for sure, as you said, that also plays a role in the way the shocks are going to be transmitted at a later stage. Thanks very much.
Thanks, Alexander. That was great. Okay, Ethan, you're up next. All yours. Can we please pull up Ethan's slides? You can just read out your disclaimer.
Yeah.
That's the first thing you probably have to do.
So thank you for having me. The Federal Reserve Bank of Boston, so the usual disclaimer applies. Okay, so the motivation for this paper are the high public debt levels in the US, the EU, and around the world. I've given you a couple of examples here, but there's many others. Now, this debt also tends to have a low interest rate, relatively in this R less than G sense or in comparison to other assets. Now, the previous literature on optimal debt policy focused originally on expenditure risk and saying, well, you know, there could always be some crisis in the future, so we should get ready for that today by lowering the debt level of the country. But a more recent literature has instead focused on these relatively low interest rates and the convenience yield on US debt and said, well, actually, maybe you can have really high debt instead. So these two literatures give completely opposite answers. One would emphasize expenditure risk is important. In fact, countries should have negative public debt in that world. They should act like a sovereign wealth fund. And this recent literature says you can have as much debt at like very high levels. So the research question in this paper is, if the government issues safe assets, what is the optimal debt target that a country should be aiming for? And also, how should they respond to expenditure crises, given that these are safe assets that they're issuing? Additionally, I ask, now how does this optimal policy compare to the actual policy of the US in particular? So to answer these questions, I'm going to build a quantitative debt model. So this is going to be an environment that features uninsurable fiscal disaster risk. So these are huge expenditure shocks. World War II can happen. Okay. You're going to have risk-averse households that are going to be willing to buy the debt from the government, but they also demand liquidity. Now, governments are going to be able to issue these safe assets that are both risk-free and provide liquidity to households. But the government, to repay this debt and roll it over every period, is going to rely on either distortionary labor taxes or what I call liquidity taxation, that is interest rate suppression or debt seigniorage. In other words, if they deny markets the liquidity they want, they can keep the interest rate artificially low, and that is some form of tax collection for the government. Now I'm going to externally calibrate this model to our standard parameters, which I'll show you in a couple slides. And then I'm going to calibrate the expenditure risk to match the history of US expenditure. I'm going to solve for the optimal Ramsey policy, and in the paper, I present first-order analytic approximations of the ergodic distributions, as well as global numerical solutions. So I find that liquidity demand is going to amplify the debt financing of governments during expenditure crises, and it's going to lead to a positive optimal debt level. I'm also going to show that this optimal debt policy actually closely approximates the history of US debt policy. So to put some numbers on this, I'm going to find that the optimal debt target during peacetime is 65% of GDP, and that the optimal convenience yield or liquidity tax is 67 basis points. So as a preview of the results, here I'm plotting the actual history of debt and primary deficits in the US, and then the optimal policy with a model with and without liquidity demand. So to be clear here, this is an externally calibrated model. I didn't set this to try and match the history. It just happens to closely match it. Secondarily, the only forcing variable here is expenditure. So in a model without liquidity demand, expenditure risk is so powerful that it drives the optimal debt levels to 0 in pretty much every period. Whereas once we include this demand for liquidity, the model pretty closely approximates many periods of the US. Okay, so I don't have time to present a full model and go through all the equilibrium and everything, given the short presentation. But here is the household's utility function. So everything in black is sort of our standard McCurdy preferences, all right? And the main term here that is different is this term in blue, a demand for liquidity by households. So here I have a representative agent in the paper, but there's a variety of microfoundations that you can use to get this sort of demand for liquidity, bonds, and utility function in a representative agent model. So I'm going to calibrate the model to our standard IES, Frisch parameters, and then importantly, calibrate to this demand for liquidity from Krishnamurthy, Vising, and Jorgensen. I have some other calibrations I'm going to show at the end to alternatives to these, in case you have some other standard parameter you like more. But these are a good starting point. Now for the expenditure risk, I'm going to have a two-state Markov chain that's either going to have a peacetime level of about 20% government expenditure, and it can go as high as 45, and then there's noise around both of these. And these are going to be persistent states. So a crisis occurs every 20 years and lasts for 4 years. So in some sense, this is a very conservative estimate of expenditure risk. Like disasters happen a lot and they last for a long time. So policymakers should be concerned about them. Okay, here I am plotting the optimal policy targets. So the experiment here is you start with 100% debt to GDP and you experience a long period of peace. In any given period, a war could have broken out, but it didn't. So there was always this fear, and the expenditure risk is present the whole time. But you happen to stay in the peacetime the whole period. So without liquidity demand, you can see the optimal debt policy is immediately negative. And in fact, this will keep going for quite a while. The expenditure risk is so strong a force in the models that you want to just have a sovereign wealth fund and have a ton of assets. Now, with liquidity demand, we're going to pretty quickly converge to 65% of debt to GDP. We're going to end up with a lower interest rate than a model without liquidity demand because the government here issues an asset with a convenience yield, which I call the liquidity tax. This is about 67 basis points here. But you're also going to see that you have a higher optimal labor tax rate. This is because the government has to fund this high debt position it's holding all the time. All right, so let's say you've been in peace for a long time and suddenly a crisis emerges. So this is a huge crisis. This is a war the size of World War II for 10 years. But this is to give you a sense of the movement of the variables. So as you can see, debt, taxes, interest rates, and output all rise in response. But having a demand for liquidity is going to amplify the effects of debt and taxes, especially. And actually, there's a fall in the liquidity tax during this crisis period. There's a fall in the convenience yield. But this is mechanical because the debt is increasing here, and thus the marginal value of liquidity is falling for households. They're getting all the liquidity they want as the market is filled with debt. You may wonder why there's spikes at the starts and ends of these wars. So if we had complete markets and the policymakers had access to lump sum taxes, they would want to have lump sum taxes during wars and a lump sum transfer at the end. And they're trying to mimic this with their taxes and interest rates, which is why we get this like spiking effects at the beginning and ends. Because they understand at the start of a war, it's going to last for a while, most likely. Okay, so let's zoom in on a recent policy. So here I'm starting in the year 2000 and having the model restart with the same debt to GDP ratio there, and asking how does actual debt policy compare with optimal. I also have here in gray the CBO projections of debt to GDP as well, given, and then the optimal policy given the CBO's projection of expenditure going into the future. Now, as you can see, the model would say that policymakers should increase the debt during great financial crisis and COVID since they're spending so much, but they spent too much in the view of the model. So about 15 to 25 percentage points in each of those two crises. But the biggest difference here, and this is since 1940 where I showed you the model earlier, is the CBO projections into the future. If the US were to continue on its projected path, then by 2035, they would be 50 percentage points off from optimal. Because in the model's view, this is a period of peace, expenditure's low, they should be running the debt down. And that's not what the projections say. All right, so with 10 seconds left, I'd like to just show this graph here. So these are some alternative calibrations I'll leave up. If you wanted to think about a different model, a different way to calibrate your liquidity demand, or different ways to calibrate your various macro parameters, I've presented them all here. And these are presenting the mean, median, standard deviation of the debt, optimal debt, as well as the target, and the upper debt limits that you would have. So with that, I conclude. I'm out of time. Thank you very much. Look forward to your questions.
Thanks, Ethan. Well done. First question goes to Bartosz.
Bartosz Maćkowiak, ECB, great paper. So the demand for liquidity may be changing over time. There may be some high-frequency movements, for example, during a financial crisis, and there may also be some secular trend. As GDP grows, as the financial system becomes deeper. Can you include these factors in your model? And what would happen? What would the model predict?
Okay.
Any other question?
Okay. So I have a section in the paper with stochastic liquidity demand like this, where I fit the history of US convenience yield, which has moved around. So treating this as like an AR1 process, kind of like Kekri and Lennell's paper, I find, yes, that like in response to a sudden demand for liquidity, this is actually great for the government because suddenly their debt is cheaper, they can issue more, they can lower their interest rates and lower taxes all at the same time. I actually have a slide in here on that, but yeah, I explore this in the paper as well. And this would help rationalize some of the recent debt as well.
Great. Maybe in terms of the motivation, I hope you get this published very soon if it isn't already. But this, R being lower than G increasingly is not really the case anymore in some of the countries that you mentioned, just for you to be aware. Okay, good. Then we are ready for you, Chiara. Yeah, all yours.
Okay, so thank you so much to the organizers for including our paper in the program. I'm very happy to be here and to present this joint work with Michele, Natalie, and Paolo. And since Natalie is at the Bank of England, the usual disclaimer applies that this does not represent the view of the Bank of England, but only of the author of the paper. Sorry. Okay. So in this paper, we start from a standard question in macroeconomics, that is whether the best way to stabilize business cycle fluctuations for the central bank is to stabilize headline inflation. And in the canonical new Keynesian model, this result is obtained because when prices are aggregated using sectoral expenditure shares, headline inflation is the sufficient statistic that summarizes all the relevant distortions in the economy. However, this result in the canonical new Keynesian model is obtained by implicitly assuming two things, at least. First, that the demand cyclicality across different sectors is the same. And second, that the share of income that accrues to hand-to-mouth households across different sectors is the same. However, we see that in the euro area, these assumptions are violated in the data. So in particular, we focus on discretionary goods and services. These are these goods and services whose budget share increases with income. So the goods and services that we consume, the more, the richer we are. Think about, for example, going to the restaurant, going on holiday, or purchasing a new car, as opposed to necessity goods and services, that are these goods and services that we consume the least as a share of our income, the richer we are. In the euro area, we see that these goods and services, the demand of these goods and services is more cyclical along the business cycle, and that the sectors producing these goods and services employ a larger share of hand-to-mouth households. So we incorporate these empirical facts into an otherwise standard new Keynesian model. In particular, we introduce non-homotheticity in the demand and labor force heterogeneity. And we revisit the question of whether is it the best way for the central bank to stabilize aggregate fluctuations by responding to headline inflation. And the model delivers two key insights. First, in the welfare that we derive in our model, the output gap has a larger weight relative to what previously understood with rank models or model with just heterogeneous agents, but without the combination of our two key features. And second, in our model, the central bank can improve welfare and so stabilize in a more efficient way the business cycle if it responds more strongly to inflation in discretionary goods and services. And this result holds even if the shocks that hit the different sectors are symmetric, and even if the nominal rigidities across the different sectors are the same. So this is a bit more in detail the intuition of what is going on in our model. So imagine there is a negative shock to household income. Households start cutting consumption. But I will show you soon empirically that they do not cut consumption equally across goods. They cut first discretionary consumption. And by doing so, they hurt the income and the employment of the households working in the sectors producing these goods and services. But again, I will show you empirically that these households are more likely to be hand-to-mouth. And so through these hand-to-mouth households that have a high MPC, the initial cut in discretionary spending now transmits to necessity spending, leading to a second drop in aggregate demand to an amplification of the business cycle. And so if the central bank responds more strongly to an initial change in discretionary prices, it can prevent this amplification to happen and better stabilize business cycle fluctuations. So this is what the data looks like. So the black dashed line is aggregate consumption growth in the euro area. The blue line and the red line are discretionary and necessity consumption growth in the euro area. And the shaded areas are euro area recessions. So as you can see, discretionary consumption drives the fluctuations in aggregate consumption in the euro area, because every time there is a recession, there is a drop in discretionary consumption. Every time there is a boom, there is an increase in discretionary consumption, while we don't see the same pattern for necessity consumption. And in the paper, we do a lot of effort to construct this time series in necessity and discretionary across several macroeconomic dimensions. And we see that this pattern is not only related to consumption, but extends to other dimensions, such as employment, national accounts, and financial variables as well. So the second thing that we do is we look at where hand-to-mouth households are employed. So here we take data from the ECB, and we follow the definition of hand-to-mouth households from Zlaka, Elektristani, and Violante. And as you can see, out of around 26% hand-to-mouth households in the euro area, 17.5% are employed in the discretionary industries, while only 8.5% are employed by the necessity industries. So we incorporate these two features in an otherwise standard New Keynesian model. So the first thing that we introduce is demand non-homotheticity. So in the model, there are two households, one hand-to-mouth and share of hand-to-mouth and the share of Ricardian households, and they have identical utility over two consumption goods, necessity and discretionary. And the two goods differ because the discretionary good has a higher intertemporal elasticity of substitution. So the discretionary good is easier to postpone. But thanks to this equivalence result from the literature from Browning and Crossley, the discretionary good has also a higher income elasticity of demand, so it's also more consumed by the rich. The second feature of the model is that there are two sectors, and the hand-to-mouth households are more likely to be employed by the discretionary sector. So then the objective is to study what is the optimal conduct of monetary policy. So the two sectors are subject to symmetric cost-push shocks, and in the baseline, we calibrate the model to the euro area. And in the baseline calibration, the central bank follows a standard Taylor rule, where it responds to headline inflation. But then when we experiment with optimal monetary policy, we change the relative weight of discretionary inflation in the Taylor rule. That can go from 0 to 1. And we experiment with these different inflation bundles. So we then derive an expression for welfare, but I'm going to skip this for the interest of time. And so with this welfare loss, this is the first exercise that we do. So first, we look at the relative weight of the output gap in the welfare, depending on the model specification. So on the y-axis, you have the relative weight of the output gap in the welfare loss, and each bar represents a different model specification. So the light blue bar is the standard result in the literature that in a rank model, the central bank should put a low weight on the output gap. The yellow bar is another result coming from the literature that we replicate that when you have hand-to-mouth agents, the central bank should put a bit of a higher weight on the output gap. However, this weight increases even more, up to almost 7 times the weight in the rank model, once you start having non-homotheticity, labor force heterogeneity, and both our features of the model. The second experiment that we do with the welfare loss is to look at how welfare varies depending, again, on the different inflation bundles that the central bank responds to, again, depending on the different model specifications. So here on the x-axis of this graph, you have the weight on discretionary spending inflation in the inflation bundle. 0 means that the central bank only responds to necessity inflation. 1 means that the central bank only responds to discretionary inflation. And each line represents a different model specification. So the horizontal bars tell us that in the rank world, in the model just with hand-to-mouth agent, and in the model without labor force heterogeneity, the welfare loss doesn't change with the inflation bundle. But once you start having labor force heterogeneity and both features of our model combined, the central bank can minimize the welfare loss within this set of Taylor rule, but by putting maximum weight on discretionary inflation. And so this result, in the paper, we do other exercises where basically we show that this result does not depend basically on differences in price stickiness heterogeneity across the two different sectors. So here in the baseline calibration, we assume the same price stickiness across necessity and discretionary. And we show in the paper that once you add the fact that discretionary sectors have higher price stickiness, as we see in the data, this result is stronger. So there is even more motive to respond more to the prices in these sectors. And second, we also do the same exercise with an alternative loss function, where the central bank does not care about the objects that enter our loss function, that depend on our model specification, but care only about fluctuations in inflation and fluctuations in the output gap, in line with the central bank mandate. And we recover exactly the same result. So there is an allocative efficiency argument for responding more strongly to discretionary inflation in light of this new understanding of the business cycle and this combination of more cyclicality and more hand-to-mouth households employed by the discretionary sectors. So let me conclude. In conclusion, in this paper, we show that some of the assumptions that are assuming the canonical New Keynesian model, in particular, the fact that some sectors are more cyclical and also employ larger share of hand-to-mouth household are violated in the data. And once we incorporate these features in a new Keynesian model, we show that the central bank can improve welfare if it responds more strongly to the inflation coming from these specific sectors. Thank you.
Very well done. So, questions? The timid reaction is very interesting in comparison to Sintra, where this paper created a shitstorm. So, okay, all the way there in the back. Yes.
Thanks, Chiara. Excellent presentation. Just one question you probably have in the paper, you didn't have time. So what happens, so when you calculate the welfare losses, these are conditioned to which shocks that you have in the model? And second, are you looking at energy shocks, for example? These are, necessity goods, I guess, and they will be inflationary. So, yeah, what happens in that case? Thanks.
Thanks, Guido. Then we have Oreste.
Thanks, yeah. Just a small comment about the fact that in the euro area we also have heterogeneity across countries in, for example, the tourist sector and the size of the tourist sector. So I wonder whether you looked also at the cross-country evidence and or maybe you have plans to do so.
Okay, and then last question.
Great talk. I was, so there's a lot of literature thinking about sectoral heterogeneity and the importance, the implications for monetary policy. One thing, it was good. Well, one thing that I was wondering about was the role of input-output networks, whether you also looked into that and whether that could change your conclusions.
Good, you have the last word.
Okay, so starting from the different shocks. So what I showed you is conditional on symmetric cost-push shocks in the model. But actually in the paper we do also another exercise where we apply this McKay and Wolf methodology, where we can actually basically look at the welfare loss just using the data. And so this is basically robust to any type of shock that have hit the euro area in our sample period that we use for this methodology. And we get the same result, that if the central bank was to apply our different rule, welfare would have been, the welfare loss would have been lower. So this is, in the model, this is just a symmetric cost-push shocks, but then we have also this exercise that, basically says that our methodology is robust to all the shocks that have hit the euro area in the last 20 years. Yes, then the countries, yes, absolutely, this is a very good point. So we don't do this in the paper because the paper is already, has already a lot of things. But this is absolutely, this has important implications for the transmission of monetary policy in the euro area, indeed, because the composition of consumption across different countries is different, or the goods that are produced by different countries are different. So this could possibly be a second paper on this. And for input-output, so this is, I didn't have time to basically explain how we construct the data set, but we actually use the input-output tables for the euro area to define these discretionary and necessity industries. Because basically we start from a classification of goods, consumption goods, from the UK National Statistical Office. But then to classify industries, you need to take into account industries producing final goods, but also intermediate goods. And to classify them, we use exactly the input-output tables to see where they sell their products more, to necessity or discretionary. So that is already taken into account in the methodology. I'm not sure if that was your...
My question was rather whether the theoretical, the predictions of your theoretical model change once the necessity and discretionary spending is also an input to the production of the respective other good.
So yeah, I guess the answer is then, okay, in the model we don't have that. It's more simpler. We have that in the empirics, and we see that so again, in the definition of the industries, and in the empirics we also do some other exercises to show that basically the transmission of monetary policy is also when we identify monetary policy shock, the transmission is stronger to these discretionary industries. So it is addressed in the empirical part of the paper, but is not included in our model.
Good. Well, as always, room for more research. With that, great applause for a job very well done, young economists. And with that, we have lunch. Can somebody help me where we go? It's just at the terrace, Oreste? Okay, so it's hard to match. You just get straight out on the other side of this floor. Or look for someone who looks ECB-ish, and you'll be in a good place.
Welcome all. It's a pleasure to welcome you to this final session of this wonderful conference. This is, as you know, the policy panel. And policy at central banks may mean a lot of things. For most people, it means just doing monetary policy. That's not what we're going to talk about today. In the research conference, the policy panel is going to be about research policy. And the idea is for us to have a conversation to get started off and then have a Q&A afterwards. The macroeconomy, as this audience knows very well, is a very complicated thing. And for central banks to be able to do good policy, they first have to have an understanding of what is going on and also an understanding of how their actions are going to affect things. And that's really not easy. We would like to think that a lot of central bank research is about that, but clearly not all of it is directly about that. And that's my first question. There are two kinds of research that goes on in central banks, those that are directly about the core mandate of central banks, and then things that may or may not have to do as much with monetary policy or policy in general. How do you see research at a central bank? And in particular, to what extent do you see research in a sense, an expense that has to be allowed to keep smart people at central banks?
Many professions, when they want to promote the interests of the profession, try to paint a positive picture. So Rafet is maybe being a typical economist by kind of focusing on a more negative self-portrait, like this tax on. So I'm going to be more celebrating the role of research at the central bank, but I would make a three-level distinction. So one, indeed, is direct to the mandate, applied, and a lot of work, super interesting work, is done here at ECB. A lot of it comes out in the economic bulletin. So those of you academics here, there are many boxes and articles published every 6 weeks, and there's a ton of interesting applications where you can see that kind of applied work. Then there's kind of a direct to mandate, more blue sky, basic research. And let me maybe give you a couple of examples, which is interesting. So before the inflation surge, there'd been a project here called PRISMA, if I'm correct in the exact acronym, which is basically about the frequency of price adjustment. And when firms raise prices, what kind of increment do they use? When I saw that, I said, okay, that's super interesting. But inflation is pretty flat. How do we make use of this? Well, actually, even though it was not on the minds, I think, of the people involved who were doing pure science, it turned out to be super useful ex post to have this concept that we need the frequency of price adjustment can change. We need to think about it, and then we need to think about it also in terms of optimal policy. And maybe in between, because I do want to emphasize that some of this is theory and model-based, but we also, at the ECB, and I'm sure at the Fed and elsewhere, need to have a quantitative sense of how important different channels are. And so in a world where it turned out that the adjustment was non-linear, it's also important that we have kind of people doing the time series VARs and so on, also doing non-linear VARs. So all of that is to the mandate, but I think the way I would interpret more kind of unrestricted research is maintaining and developing the human capital of the staff. And who knows when that human capital will turn out to be important. Again, someone may spend their whole career not doing a policy role, but by being in the building, other people interacting with them, I think it permeates. I mean, I spent 20 years as a pure academic before joining the central bank. And I think that kind of investment in research, reading, writing, investigating, it's important as you go more senior in the organization that you have a fairly strong platform of having that real time in research, not just kind of browsing.
Fair enough.
Well, many of you probably read, but last May I gave a speech on the value of economic research and policymaking. If you haven't read it, go find it and read it. But I'll kind of give you a couple of the key points that came out of that. When we think about academic style research or frontier research, what is the nature of that research? It's free thinking. It's thinking about things that haven't happened yet and trying to say, what if this or what if that? And we walk through models and what are issues you have to think about. The key thing is not time sensitive. The other thing we do with it is we send it out for peer review. We want to find out what the profession thinks and, to find out where it's wrong or it's made mistakes or how to improve it, okay? And that's a real critical aspect of it. When you do other types of like what I used to call directed research when I was the research director in St. Louis, that's very time sensitive. Something happened. They need some analysis of it right now. So it's quick and dirty. It doesn't go out for peer review. It's not forward-looking. It's dealing with a problem that's happening right now. And when they have to do that analysis, what's the foundation for doing it? They're not inventing new theories at that moment. They're going on to the existing, typically academic literature and saying, what's been done on this? Okay, and that's what's important. So I'll give you just a couple examples from like when I was in St. Louis. We had some people doing housing. And then people were like, why are we hiring housing economists at the Fed? We do monetary policy. 2007, 2008, what does everybody want to know about? Housing in the US. So all that work had already been done. It wasn't like we had to go do it. Same thing. We hired several trade economists in St. Louis. Jim Bullard, who was the president, looked at me one day and said, what are we hiring all these trade economists for? And then Donald Trump gets elected. And what happens? All of a sudden, trade, tariffs, everything is a question. We didn't have to go scrambling and look for new research or new ideas. People had already been doing it. So that's really the big nature of doing it kind of in advance. You've already thought about it before it ever happens. And the key point of all this is doing the directed research is exactly what we do. We do the academic research, we do it, and then when the problem pops up, we can put together a memo or we can put together a quick analysis of here's what we know from the issues. So that's the thing is we all do both. It's not that we do this type of work or we do that type of work. We do both and both are extremely valuable in a central bank.
I fully
Go
agree.
read the speech.
And bookmark this part of the conversation on your browser so that when you are pushed for more policy work at the expense of your research, you can come back and say, remember you said this. Excellent. The other thing that's interesting is the intersection of research and policy. And it works both ways. And I wanted to ask you, if you think about, for example, inflation targeting, that's an example of research chasing after the practice. QE certainly was, right? But there are cases where there are ideas that come from the research side and then feed into policy. Are there examples that you have in mind that you would say, we wouldn't have thought of this maybe, or the central banking world benefited from research in such and such ways, such that you were giving examples of trade and housing, but in terms of broader things in the policy framework design, the research actually fed into the way central banks operate, and that was good for humanity.
So I find it hard, but maybe that's just me, to think of research ideas that kind of purely originated in research. I mean, I think even the most abstract researcher is inspired or driven by something. So I'm not so sure I would say there's a kind of unidirectional move from research to policy in that sense, which might, if we thought of some other policy area in the science, there might be, but in economics. But what I would say is when we think about monetary policy, the transmission of monetary policy, a lot works through how asset markets are set up. So these concepts of segmented asset markets, preferred habitat, the kind of balance sheet constraints on the intermediaries. And a lot of the history of those ideas were super abstract. Going from super abstract, and that's not, I never kind of contributed to kind of working on those. And I remember when I was doing my PhD in early stage, listening to people who are doing that kind of super abstract, okay, that's super interesting, but I don't see it. I don't see the application. Whereas I think over time, indeed, as Bernanke said, QE works in practice, but not in theory. And to a certain amount, maybe the first wave of QE was more in 2000, in the financial crisis, was driven by crisis management. But then the pivot from crisis management to being like a stance instrument did build on essentially having to come up with kind of augmented monetary models with financial frictions, which is really the intersection of macro, contract theory, industrial organization. Many things came together. So I think, and then when we think about QE in particular and the kind of extracting duration and so on, the framework of Vianas and others on preferred habitat, I think turned out to be useful. And actually, I think, when we tried to calibrate QE, and so, I think we got, reasonable outcomes on that. Let me emphasize, because I think it's been a comment I've heard both yesterday and today, is lamenting that the incentives are to work in the US economy because it's easier to publish. But I would say, when we think about the EU area, although, of course, balance sheet policies are used also in the US, the way balance sheet policies work in a monetary union of 21 sovereigns is different to the way it works in the US. And this is where, I think we've really benefited from researchers at the ECB and the national central banks, like the Bank of Spain and Bank of Italy and so on, and outside who've really thought hard about what does a monetary union look like. And Giancarlo today had the keynote. He didn't really do monetary union elements, but the work from 30 years ago and 20 years ago has really been important on that. So I would say, as Chris said, essentially, when you actually need to do something, it's too late to develop a new theory. You need the prior work, and that's really where there's a huge debt. Maybe totally underpriced. So maybe there's a massive externality from the academic research world to policy. Now, to some extent, we try and give back to that community, but maybe not completely. So.
Thank you. On that point of working on European questions, 2 years ago, a group of us, including Carlo Altavilla here, wrote a little, call for action that said, European questions are really interesting questions. We care about the people here. And unlike what people often assume, there's actually terrific data that allows one to answer empirical questions. Today, the data on banking and firms in Europe is actually significantly better than similar data in the US. And there's a lot of reason to work on questions that are dear to our hearts, and there is all the resources to do so. So, of course, ECB economists don't have to be told this, but for a broader audience, that really is an important avenue for research for us. One area of research that is really dear to central bankers' hearts is research that feeds into forecasting. And of course, we never get applauded for the forecast accuracy, and when it's not all that well, we hear an earful, as was the case in the recent inflation run-up. But forecasting inside central banks has its own challenges in that, as a central bank economist, if you ask me forecast inflation 3 years down the road, a very good forecast for me would be 2%, because I trust you, surely. That's not very useful, but it's not very easy for a forecast to be, 6%, where I'd be telling you, well, my guess about your monetary policy is you're going to colossally fail and inflation will be way above target in a long enough horizon. And that's a really difficult problem in that, from outside the central bank, forecasting is a joint exercise trying to understand what shocks will be hitting and how the central bank will be responding to these. From inside is the responder trying to decide. And that's at every central bank, it's a perennial problem, what the relevant baseline interest rate path should be. If one is to take optimal interest rate, then the forecast will always go to target perhaps too fast. If not, then what are we talking about? Is it the staff's way of telling the policymakers you're going to fail at your jobs? So research on forecasting is a particularly difficult exercise inside central banks. What is your take on, when forecasting works well, when research feeds properly into it, and in particular, how the staff's opinion of the monetary policy path should be thought of in a forecasting sense?
So I've always kind of had this view on forecasting that if you really just want a number at a certain point in time, to me, that's almost a purely statistical exercise. You take the data, you take the econometric model, whatever, and you just run it and find the best estimate for that number. Okay, that's great. And then when somebody says, and why? Now I got to have a model. Now I have to have some economic intuition. Now what you're doing is you're moving away from the purely statistical to having some economic content behind it. And then you say, well, wait a minute, there's a lot of anecdotal data coming out right now that's not in the historical data that might be telling us something. Well, now you're trying to sort of ad hoc that anecdotal data into the forecast. And that's where kind of the art of forecasting. So that's what I always try to tell people. If you want a pure, just accurate number, I can run it, but then don't ask me why I got that number. If you want some explanation, if you were a private sector economist, your clients would say, why? They want to know why. You don't just get to throw a number at them, they go, fine, take it. So I think that's really what we have to do too. We have to take the data, do this, put some intellectual framework around how to interpret that data, and then how do we bring in data that's outside of the model or outside the statistical model to help us shape that forecast. So there's an art to it. And if you get some part of it wrong, that's just the nature of the game. You're lucky if you can forecast well out past about 6 months. I honestly believe that once you get out to 6, maybe 12 months, after that, flip a coin. I don't know what's going to happen after that. But I think that's always been my view of forecasting, is it's a combination of all these elements, and if you don't have it, the thing's not going to go well. So I'll just stop there.
Can I ask you what interest rate path you want your forecasters to use in general? A market implied path, or what they think is optimal, or what they think that you will be doing?
Well, I mean, you write down any kind of model which you're using. I mean, if it's not a pure statistical model, then you've got some framework. We have FERBIS at the board. We have some, economic model that's underlying it. And then you have to say, well, how's policy being determined in the model? Now, you can say, all right, let's just take the median of the SEP and feed that in and see where it goes. Or you can say, give me a Taylor rule of this form or that form and this form, run it through, and then tell me all the possible outcomes off the Taylor rule. And we do all of that. I mean, we do this kind of very broad discussion of how we want to think about policy. And then you're comparing to see, how far off would we be as the actual human making a decision compared to what a simple Taylor rule of some form would look like. So you're doing that to kind of check your own judgment about what I think the path would be. Is it way off of what some other model or Taylor rule would tell us to do? So, but what I don't want to do is go to the staff and say, all right, here's my belief on what I think the interest rate path is, plug it in, and then justify it. That's not the game you want to have. Tell me why I'm wrong. Tell me why there's a better path to do this. That's why I talk to you guys.
So maybe it's useful if I kind of complement that. And again, the one difference is our staff publish the forecast. And so it's important to have a clear line of differentiation between the staff work and then the staff also advise, but in a stage 2. Given that forecast, stage 2 is also show me what happens under alternative rate simulations. And I think it's inescapable, the staff forecast. And remember, we alternate between an ECB forecast and a Eurosystem forecast, which is all of the 21 NCBs. I think it's inescapable that the market curve is going to be the curve underpinning the forecast. And as you said at the start, I mean, people need to remember always, it would be a problem if 3 years from now, inflation is not 2%. So either the market doesn't understand or they don't believe us. Yeah. You know, so that is a problem. And in March, we did put out this tail scenario, this severe scenario where inflation doesn't, you know, come back. But that's basically saying, but that's because, I think it was at the 95th percentile of the energy price distribution. So the market curve was not pricing us to be up there. But of course, if we did go in that direction, then the market curve would respond. So what I would say is, and again, I think now there's been a lot of work of the staff to develop these semi-structural models, which are a bit like FURBIS for the EU area. And that is the baseline. And as Chris said, you do need to be able to have a narrative. So when I see the forecast in presentations, it's basically, here's the shock decomposition, here's what's driving it. But let me come to the add-on, the judgment, where again, for us, it's staff judgment, whereas I presume with the dot plot and so on, it's each of you and the FOMC is free to play around, you know. Yeah. But for us, we're looking for the collective judgment of the staff. And what I would say is very important to us is the staff can stand over that judgment element. And that's where all the other models, the satellite models, essentially, many say there's some kind of nonlinearity going on, or there's some reason the traditional elasticity doesn't work. But then the staff need to say, well, we've run this satellite model where we allow for the nonlinearity, and that means we're pushing the overall forecast by X. I think there's some work we published here at the ECB 2 or 3 years ago, which basically says judgment at the ECB tends to be in the right direction. That's reassuring.
At least it's going the right direction.
So it's not random, and that's very important because, as you say, if we just take the basic model and run it, it doesn't take once the model is built, it doesn't take too many resources to press the button. So it's the extra, it's the building the narrative and doing that kind of sensitivity to alternative satellites is important.
Yeah, I just want to follow up. The anecdotal evidence and real-time data is really, really valuable for where we do these exercises. I'll just use one example for my own past, and that was back in 2021 and 22. Inflation was starting to take off. There was this thought we had to start tightening policy soon, and everybody's like, oh, if you tighten policy, you're gonna crash the labor market. That's what a standard Phillips curve's gonna tell you to do. And I'm sitting there going, wait a minute, when I look out there in the US right now, there's 2 openings for a job for every person looking. Why would people suddenly start firing their workers because I raise interest rates when they can't even fill the jobs they've got? So, and every firm I talk to would say, so if we raise interest rates X, what would you do? Would you fire your workers? No. I spent 3 months trying to hire this person. I'm not going to let them go because interest rates went up. So I kept hearing all this anecdotal data. So when we started raising rates, every model that we had said, you're going to cause a recession. Unemployment's going to go, I think Larry Summers said it was going to go to 9% for 2 years. And I'm like, I don't think you're looking at the same anecdotal data I am. And so I said, no, I don't think that's the case. Well, that worked out. But if it hadn't been for all this anecdotal data being told, I'm not laying my workers off, the model would have told you this is the cost of doing that interest rate policy. So it's kind of taking that stuff, putting it into a model, trying to think through, and I did this whole beverage curve argument. But it was, again, trying to think of a model that matched what I was hearing and how it would all tie together. So that's really, I really am a big believer in how, if you get enough anecdotes, you tell yourself that is going to be the data in the future. It's an anecdote now, but it will be the data in the future. So use it now and don't ignore it.
I think that's a very powerful example, but let me also emphasize, I think it's true for us, maybe it's also true in the US system, there's also people come across an anecdote and they say, oh, this is really concerning me. And we hand it over to the staff and say, okay, the mechanism exists. but actually it's going to be nearly invisible in the macro data.
Yeah, quantitative.
You know, so in the sense of that's also part of it is that the negative role of kind of research is basically to kill bad narratives. You know, so what Chris said was a very powerful narrative, but you know, every so often, and I'm looking at staff members who probably might agree with me, occasionally you get bad narratives, and the role of the staff is say, okay, we're not saying you know it doesn't exist, but quantitatively, don't worry about it.
Yeah.
This discussion about anecdotes and judgment actually relates to what we were talking about earlier, in that, in particular, if you need judgment, you need people with good judgment, and that's where, you know, having the good researchers with the good human capital really comes in. On the other hand, if you're relying so much on judgment and anecdotes, you know, all these modeling exercises are perhaps not as useful as we would have hoped they would be. So I'd like to come back and ask about that. You know, when thinking about, for example, policy counterfactuals, not forecasting, but the counterfactual, where one has to have a theoretical framework, has to have some model so that the counterfactual is meaningful and consistent. How often do you find yourself saying, okay, you know, we have all these models inside the building and they give me these counterfactuals and I'm happy with that, versus saying, well, and then I have to push the staff to exercise judgment, or have to add in my own judgment, perhaps more often than you would like to?
So on counterfactuals, I think where the anecdotes come in, and also it's possibly sometimes not the same people. So the people who are the model builders may not be the people who are going to some OECD working group or some, you know, doing some market intelligence, which are coming across interesting issues, let's say about the energy market, that here's something going on which you really need to know. So I think in specifying the counterfactual, there might be temptation by the pure researchers to go for what they know. For example, in a lot of cases, I think we had it this morning a bit, it's a lot easier to do a temporary shock for stability reasons. But actually, I really want to know what happens if this is a permanent shock. There's a level shift which is not going to reverse. And that can be annoying for researchers because it's not so easy to do. But from the point of view of a... So there's probably some push and pull in terms of what goes into it. I think also there's a temptation, I think sometimes, to do things one at a time. But in the world we live in, let's say the tariff shock or now the oil shock, there's other things going on. And if you really want to kind of get to a policy relevant answer, if you say, well, here's what I ran, okay, but maybe you want to think about, has there been also at the same time as a tariff shock, a risk aversion shock in the financial system, or what have you. Or going back, quite often there's an endogenous fiscal response. So again, it's more work. So, you know, I think, remind everyone who's from the outside world who says, please publish more scenarios. We're kind of curating the scenarios because just kind of bombarding you with, I mean, the information in the published scenarios is, why did we publish these scenarios? What made us, because of course we can run many things. But I do think scenario analysis is important, but for any given scenario, looking at the sensitivity around it, and maybe since we're talking about it, one thing that's, I think, important and is developing is also giving a sense of the likelihood of different scenarios. So if you tell me, well, you know, here's a scenario, but by the way, historically, there's never been any episode where output and inflation have co-moved in that way, versus, well, actually this, because if you look now, people say, is this like 2022? Is it like 2011? So combining the scenarios with kind of, okay, here's a matching or kind of a propensity matching type thing where this looks a bit like some previous episode, can help various people understand what's going on better.
we're coming to an end of a almost 2-day wonderful conference, and very oddly, the topic of AI hasn't come up yet. So we're gonna correct that wrong now. And I'd like to ask Chris about, to what extent one might or might not want to allow or encourage using AI in central bank research, in the sense that you very nicely articulated the point that when you're scrambling to do policy, you don't have the time to do research on it. But perhaps, given the new technology, we are able to produce research much faster than before. On the other hand, maybe we don't want to produce research that fast because we want things to be tested properly before they are used for policy. What is your view on using AI for research purposes at central banks?
Well, I've always viewed AI as a tool. I tell this to everybody within the Fed, whether you're a researcher or not, it's a tool to help you be more productive. That's it. We're not putting it in to take your job. That is not our intent. We want you to do your job more productively, more efficiently, so you can take your time and do other things of higher value that you were constrained before. And that's really kind of the key thing. Now, in terms of research, within any central bank, what data and information are you going to feed into this thing? And that's very sensitive, right? You don't get to just put anything in you want. You also don't get to just run some output and then copy and paste it into something. Hey, I came up with this great piece of malware. Let me see how it works on the Fed system. No, you don't get to do that stuff, right? So there has to be guardrails on what happens. So we make sure that this stuff doesn't get out, or if we use inside information, it's not somehow used or helping the companies use our inside information to develop their models. That's just a risk management problem for most of what we have to do. So I know at the Fed, we've built a sandbox where we have a bunch of different AI models that are provided to us from AWS through the cloud. We have some guardrails. We may not have the most up-to-date, cutting-edge model because we had to kind of check through and set things up. So that'll be the one cost to the researchers. You may always be a little bit behind doing your work at the bank, but that's the risk we have to protect against it. Other things don't happen. But I think it's an amazing tool. I would like, in situations like you were describing, if you just want to summarize the economic literature on tariffs and, let's say, inflation, sounds to me like this would be a perfect way to have AI generate a summary of all these things. What are the key things? What are the key findings? And we don't have to waste economists' time for a week digging through journals and trying to summarize it and type it up in an Excel spreadsheet. That's what I see it as very useful for. We do things like our meetings. You have transcripts of the meetings. If you want to do an executive summary of the whole meeting, run the transcript through. It gives you an executive summary. Very fast and efficient way to do the minutes of our meetings. There's lots of really nice ways you could use this stuff in a central bank to make us all more efficient. But like I said, in terms of research, you're going to have guardrails on it. We're probably not going to let you sit on a plane and run stuff on your laptop that has sensitive policy information on it. They won't even let me use it to clean up my email. My email, nobody gets to screw around with that because of the stuff that's in there.
But I mean, quite similar observations, but what I would say, I mean, going back to the idea that part of what people do is research for external publication. And of course, now with all of the different ways you can improve your, I mean, if it's going to a journal, it's already got to the point where it's kind of safe information. And there, because I think probably there might be, historically, maybe at management level, okay, they've written the paper, it's 95% going to remain that paper, but it takes so much work to go from 95 to 100 to get it into a top journal. Do we really want that guy spending that time? Whereas I hope that revision, polishing, with these kind of agentic referees and so on can help that. But going back to, I mean, you framed it as rapid response to an emerging issue. I would hope the staff have the imagination to say, okay, yes, I'm more productive. let me build up my library of all sorts of different scenarios. I mean, I saw something on, I think, Tyler Cowen's marginal revolution thing the other day. We're saying, like, the future of a paper is basically it's going to be a portal. You've got the paper, and then it's like a Q&A, saying what happens if X and Y. And the more you can turn your paper into a product. And this happens inside, I'm sure it's inside, in the ECB, a really successful project is it goes from being just a paper to being in the toolbox, where you can press a button and you see the updated estimates. You can press a button, and so already, because the pressure from policymakers means people do want to make their research useful. But I would guess more generally, that's where AI, like that annoying, step from having the basics to having a polished interface for other people. So I'm very positive also on how to, making everyone more productive, but probably means a two-layer life as a researcher. The inside layer, where you don't want things to leak, and you may have to be at a kind of lag, versus the outside layer, where you're just part of the global research community, and there you can, on your home computer, go to town.
I love this idea of just have the paper be the engine.
Right.
All those referees that say, well, do this robustness check or do that one. You say, do it yourself.
That's always referee two.
Do it yourself. It's right there. Click the button. Don't make me go do it.
Before we turn to Q&A, let me see whether I can get a research mandate out of you too. On, given the policy problems you're dealing with now, what are some of the things that you wish somebody had done the research already on these things that, such and such questions would be answered by now?
Yeah, I mean, just thinking of something right off the top of my head that we're dealing with at the board, and some of the staff that are here, they can. But one of the things that has, you're sitting here and you hear the following: the Trump administration has a big deregulatory agenda. This is going to unleash growth on the economy. We're going to eliminate 3,000 regulations that are all very micro-oriented. All right, now how do I plug that into a macro model? Right? It's easy to say, take this regulation in a micro thing on one particular thing, but then to say, take several thousand of them, put them in. Are they binding? Are they not binding? This is back to Philip's point. Quantitatively, are they big effects or small effects? But that's kind of what we ask staff at times to do, is how do we think about putting in a massive deregulatory policy into a macro model to spit out what it's going to do to economic growth, inflation, deflation, whatever. I mean, it's not an easy question, but it's kind of a question that policymakers need to do. And I know staff from the board that are here, people are working on that, trying to figure out how to do that.
I mean, clearly, structural reform has been a topic in Europe for forever. And there was, 10 or 15 years ago when Europe was trying to get out of the crisis, there was interesting work both here and actually in the Federal Reserve System asking, indeed, can you get front-loaded benefits? Because structural reform as such, in an annoying way, show up in productivity and growth 5 years out. So from an election cycle point of view, 5 years out is a bit frustrating. But in many macro models, you should get a front-loaded response because of anticipation effects in terms of consumption, asset prices. Now, part of this, showed up in monetary policy, the forward guidance puzzle and so on. Why do people discount the future so heavily? So I think there's an interesting issue about, on the one side, the productivity type effects, but I think it's everywhere right now with AI, with lots or structural reform, anticipation of future productivity. When you then layer in uncertainty about, you may say, well, in the aggregate, the economy is going to benefit. But I'm not so sure I'm going to benefit because the churn involved with structural reform means my particular occupation or my particular industry, also for AI, means there's more uncertainty. I think both now and going back over the decades, there's been a lot of work on this, but it is a super interesting topic. And maybe I'll just mention, because again, financial intermediation is obviously for transmission quite important. And the world we're living in where, digital finance, lots of changes in the structure of the financial system is again somewhere where there's kind of interesting abstract work about what does it look like, but trying to map the financial system we see to the concepts we can model is an interesting challenge.
Thank you for that. That was wonderful, and we have some time for Q&A, and it's not always that we get to talk to two people who are themselves so much into research, have done it, and therefore are able to appreciate it, and are now doing policy. So the floor is open, and let's begin with Anna here. And a microphone is coming your way.
Hi, Anna Lipinska, Federal Reserve Board. So I wanted to ask you about organization structure, like between research and policy. So we have, the board representative and ECB representative. At ECB, you have a dedicated, directorate for research. At the Fed board, we don't have a research department, but at the same time, there is this view that, everybody, every economist has time both for policy and research, and in order to do research of quality, you have to be exposed to policy firsthand. So can you talk about advantages and disadvantages of each of the system, or what should be the optimal system, or maybe it doesn't matter? So just wanted to hear your views about that.
Yeah, when I ran the research department in St. Louis, this was always a thing. Should we have people dedicated to the policy stuff and then pure researchers? And I kind of gave you my directed versus academic research answer in the beginning, and the answer was, you do both, right? And if you're on the policy side and something comes up and you don't follow the academic literature, you don't know what's going on. If you're on the pure academic side and something policy, and you're like, I have no idea. You pop your head up once a year and look around and say, what did they do? It doesn't, then you're kind of so far out of it, you're not helping. But on the other hand, there's long this kind of argument, why don't we just specialize? That's what economists like. You specialize in this, it's more what your interests are, I'll specialize in that. And if we both specialize, we get a better product at the end. So I don't think there is a right answer on this. It kind of depends on what you want your people to do. And your models will attract certain economists or not. And, but I always preferred the model where you had to do everything. It kind of made you more knowledgeable about policy, and it also kept your foot as a policy person in the academic world. That's my thoughts.
I think if you do have the system we have where there is a standalone research group, it's not going to happen passively that the right amount of interaction between research and policy takes place. So here we have a system of research clusters, which brings together the people in research, but also there's a lot of research done in the business areas. So it's important to actually do the effort, which Luke and his team have to put together, of having these clusters so that people know, and it's one building, it's a big building, but the culture has to be, and the culture has to be from both sides, that it's expected and encouraged that you get to know the people who are doing the counterpart policy work to the research you're doing. Mobility, where possible, and we actually have right now there's some rotation between research and some of the policy areas. So people in the end, I hope, know they're working for the ECB. And the organizational chart is secondary to the culture. And again, I would say, if you're a researcher, I hope you really want your research to not only be published, but to make a difference. So I think that there's a lot of incentives already to make sure that the information and the effort flows in both directions. It's a good question.
Yeah. I would say it's also important to be able to make exceptions for exceptional people. Right? Even in a system like the Feds, where everybody does research and policy, every now and then you get someone who really doesn't want to do policy, but is the kind of person that Phil was talking about, the kind of person you want to have in the building because that person is useful to others. Someone who's an expert on solution algorithms. It's important that one is able to carve out a position for someone like that, where you get to tell them, okay, you're less of a policy economist, but we think of you as a plumbing person here, and we'll let you do your kind of thing because having you here is useful.
Yeah, I've always been kind of opposed to that because then it's like, well, that person's special. Why am I not special? And then who gets to decide who's special and who's not special? You all get treated the same. That's always been my rule everywhere I've ever been. If you really need somebody that specialized who doesn't want to be in policy, bring them in as a visiting scholar. You don't need to hire them. Just tell them to come on in for some period of time and then interact with them that way.
Yes, ma'am.
Philippine Corsiman, ECB. I would like to draw on your discussion on AI and the use of AI in research. And let me share just one intuition, because coming from the looking at the US subprime crisis, then sovereign debt crisis in the euro area, we would not have found in the books or in any place or in the internet the mechanisms through which were developing under our eyes. And when we were doing market interventions, the first days in May 2009, after the weekend, I had to write the rationale for the ECB on why we do that. There was nothing in the books. There was no mechanism, no transmission mechanism where the role, or no model where the role of government bonds would be set for market liquidity, for transmissions to interest rates, and so on. So I see the risk when we do use AI, it can only be based on available information past, like DSG models were based on past developments, and we relied too much on them. So when the crisis happened, we were like abandoned by what we had been doing in research. And so I would think one analogy I find here is in the same way as we had too much reliance on our linear models and knowledge and TSGs and so on, we didn't look at the not likely or very little likely scenarios, and then happened the crisis. With AI is by design based on the most likely. So maybe there is some analogy to do on what that means also for careful use in research.
Maybe I'll respond, because I think it's a super revealing example where essentially, actually, I would flip that around. So humans in the central banking community might have had too narrow a focus. But when I think about the economics literature, there's massive amounts of work on currency crises. So in other words, there had been plenty of financial crises before 2008, but they were in emerging markets. And so the AI might actually have seen beyond the narrow focus of the European Central Bank economists and said, well, actually, when I look at the whole corpus of the academic literature, I see that. I also see the kind of Diamond-Dybvig kind of bank run models. And in fact, this is an interesting issue because, I mean, the BIS now has this online time series tool, which basically, if you hand over like how to forecast inflation, in the paper explaining this tool, they say actually it did a better job in the inflation surge, essentially because they had a much more open mind about the priors than someone who's kind of schooled in it particular. So actually, I would turn that around for the field and say, this is actually maybe, and I'm sure it could be done actually, if you stop the AI learning in 2006 or something and say, and then you go through the scenario that actually happened in August 2007 or March 2008 and so on. That could be an interesting test. Would it have actually revealed a lot more? So I'd be hopeful the wide lens of AI might actually be more helpful than you might indicate.
Anton?
Anton Nakov, ECB.
How do you insulate researchers from pressure to produce research which is supportive of existing policy positions?
I don't have that problem because I never tell them to do that. I usually ask them, how can you help me come up with a framework that makes some sense of what I'm trying to say? I mean, that's what I did with the beverage curve, talking to Andy Figuera. I had this idea that there were all these vacancies. I was just thinking about supply and demand. You got demand way outstripping supply. There's all these vacancies. You can push down the labor demand curve and get rid of all the vacancies, and employment's determined by the short side of the market. And then Blanchard says something to Jay Powell about, yeah, you can't do that. There's this thing called the beverage curve. Shit. Oops, sorry. So then, you know, we start talking to Andy, and it's like, no, this all makes coherent sense. You know, it's just, you're on this really steep part. So it was like I had this intuition in my head, but I didn't know, just supply and demand wasn't cutting it. So and then I was trying to figure out, well, how do I want to think about this? And the staff helped me, not that they were trying to justify it, but give me a framework that it made sense as opposed to it just didn't quite work. So I don't say, here's my view, give me the model that justifies that view. But is there a way to make sense of what I'm trying to say? And if they say no, sorry, then you toss it.
I think I have two answers, Anton. One, it's important of the governance, because it protects the staff and protects also the policymaker if basically there's no sign-off of working papers and so on. So basically, and I'm sure there's a disclaimer that it's the work of the researcher. So that is one. But I would say, if I read something and then someone, I mean, this is more of, I think, probably an academic might do, or a student would say, and now here's the dramatic policy conclusion coming from my model, because they're trying to maybe amplify what the model says. Whereas, if there are policy conclusions saying in the context of this model, so just being, for me, a bit low-key, because no model is going to capture everything. So I think it's robust to say, in the context of this model, the policy implication is X. You don't follow that sentence by saying, and therefore, the ECB is totally crazy or whatever. It's to be scientific about it, as opposed to, because so that's what I would say is it's important to spell out. But most results are, there's a model-specific element to it.
Thank you. Yes, please.
Matthias Meyer, University of Mannheim. Mr. Waller, you mentioned hiring trade economists, hiring housing economists, when that was not, those topics were not part of the policy debate, and it turned out to be a type of precautionary measure. My question to the two of you is, which subfields of economics do you consider precautionary? Do you consider a good subfield to hire for precautionary reasons? What may be the topics of the future?
Yeah, I mean, we've struggled with this, within any, like when I was research director, you have so many slots in your department. You got to kind of choose, do you want to have more in one area or do you want to have more breadth? Those are trade-offs you have to kind of make. I always kind of said, look, I don't really need any health economist at the Fed. It's not that this isn't important, but the health stuff is a much more longer demographic trend, and I can get scholars in to visit to talk, but I don't need to hire like a health economist. I don't need to do anybody doing field experiments, putting up mosquito nets in Africa either. I'm sorry, that might be really cool, but it's not really that relevant for what we do. But then you have to kind of think, so like the housing one, well, what's one of the main mechanisms for monetary policy? Interest rates and housing. So maybe that's not so far-fetched. Trade, we don't do as much with exchange rate control in the US, but you'd have to understand how this works, and exchange rate stuff is always floating around in economics. So again, there's a tie to it. But it's not like every day in the Fed we sit and go, okay, what's our exchange rate policy going to be? We don't talk about it at all. So I always try to think like, what is it that gives me some value that's on the edge, but it's not too far off that there's no point in me having people in the department providing me that kind of research.
Let me add on. I do think, I mean, there's some very good work on international macro at the ECB, but I think Europe is shrinking as a fraction of the world economy. So in terms of the origin of productivity, you know, a lot of productivity, which is, you know, driving trend output, is going to be global. So understanding how the world fits together, even before you get to policy questions like tariffs or FX intervention, just understanding, if I want to understand what's driving the European economy, I think, you know, global trends, global shocks are very important. And it is there, but you know, I'd like to see it more mainstreamed and more people working on it. And that is a field that's not so big. So, and it's difficult. It's a difficult field.
We can take a last question from Professor Dr. Guido Ascari, who is himself an academic and a research director.
Yeah, no, thanks a lot. Very, very insightful. So I cannot get away with this sensational, with this feeling. You get two extremely good researchers that who actually happen to join policy at a very high level, and we got a bit of preaching to the choir here, right? In this sense. So let me try to shake you up a little bit, if I can. So
we're really good at not getting shaken up, Guido. That's what's the criteria for getting the job.
So during your experience, right, your experience changed the way you're thinking about research, or you have been thinking about before you joined, and about the usefulness of research. And second, in your role, in your boards, did you interact with people with every different background for yours that maybe think about research in a very different way, and also about the usefulness? Can you get any example, if you want, in which you had to stand up for researcher, for research, or for the research culture in your organizations, some way, in some sense, in your interactions?
You have an answer to that.
Well, like I said, I've tried in the speech I gave last May, when there was some political criticism of economists, and particularly economists in the Federal Reserve. I was trying to say, look, this is their value to us and what they do. And we need that. We need that both. And it's not that people are off doing airy-fairy stuff. It's just that stuff suddenly becomes important one day, and we don't have to go redo or invent the wheel at that point. We rely on this. I think Philip said you're this set of human capital, these walking, talking encyclopedias that you may never pull this book off the shelf, but one day you're like, I got to know everything about that topic, and I'm going to go over to that person on the staff. And I think that's a little different from like even when I ran a reserve bank. The board staff is big because there are these minutia kind of topics that we need people to have very good understanding. You may never talk to them in 10 years or 15 years, but that one day when you need an answer to something, they tell you, go talk to X. So I've always felt that I can't do my job if I don't have those people. I can't go out and talk. I can't go out and address questions from the public and give them coherent answers if I don't have the staff behind me backing me up.
So what I would say in terms of the role of research is there's definitely a science to monetary policy. And this goes a very long way in helping us make decisions. But there's also, an element of an art to monetary policy as well. And so it's important, I think, for those who are not coming from a research or background, to preserve that space, to say, well, so if you take the rates, the staff do these rate simulations, but they are model-based, they're model-specific. But of course, when you get down to the actual decision you need to make, all sorts of factors go into that, and to essentially preserve the room and the kind of space for the policymakers to recognize, okay, in other words, that the science does not dictate the outcome. There's not a unique answer from a policymaker point of view. And I think, even within the category of rate simulations, the choices you make in how to do those rate simulations. So recognizing where the limit is for research, and then where the policymaker who has all sorts of perspective comes in. What I would say, and I don't think it's in the central banking world, but there's a whole narrative out there about models. But the people who know the weaknesses of the models the most are the modelers. The people who actually do the work, they're the ones who really, I once wrote a letter in the Irish Times decades ago. Someone had this comment. I said, look, it takes about a day to learn the kind of first welfare theorem. Here's the conditions in which everything is fine, and the free market creates the efficient outcome. The rest of your degree and your postgrad degree and your doctorate is all the deviations from that. So the idea of this caricature that models are kind of idiotic, basically. It's such a, it's not true. So there's probably, again, not so much, because everyone involved has an appreciation, but to the external world, saying that there is a basis for, and what I think I would try to encourage here, and you see it, a lot more of the detail of the models are being published in working papers. There's a lot more disclosure, and the more people can see what we're up to, it has that external challenge, and it helps the analysts out there who have to track us to understand better the models that we're using.
Super. It's actually surprisingly rare that the two sides of the Atlantic get together to talk about stuff, where stuff isn't some immediate policy concern, but how things are going, how we are handling various concerns, how we're thinking about policy frameworks. This conference series is probably the flagship event that does this for central banking. And the people who started this in 2002, I'm sure they're proud to see that after almost 25 years, it's going strong. And we had a wonderful 1.5 days talking about research and central banking and monetary policy. So on behalf of the organizers, thanks you to all of the presenters, all of the contributors, and all of the audience. And special thanks to our hosts at the ECB, who've really taken very good care of us and made sure that everything worked excellently. And special thanks also to the two greats here who spent their time talking to us about why what we do is worthy of doing. Thank you so much.
Thank you.